Consumers in Asia are going to go along with the more quiet luxury, more understated luxury fabrics kind of vibe.
Can we just define what quiet luxury is? Because I didn't actually know
this. Quiet luxury is no logos.
So it's just no logos.
It's like quality
fabrics.
fabrics.
Colors, it's just no logos.
No. It's not muted colors. It's like quality fabrics, handmade, artisanal, but no logos.
There you go. We've done justice to the luxury theme. There will be other themes in play, no doubt, this morning.
Excellent.
A few seconds to go until the start of equity trading this morning. I should say the futures picture is pretty uninspiring. We're waiting for the Fed, of course, today. We know that's the big macro theme of the morning, and we're excited to see the dots that go along the summary of economic projections that go along with their expectations over at the Fed later on. So the start of European equity trade has delivered, well, a little bit of downside for European stocks. We're down by 0.2% on the stock 600. The FTSE opening just a shade into the red. The DAX threatening to go a little higher, but not much movement, and US futures look almost, flat.
LVMH is down by 3.2. Richemont is down by 4.1. Even Hermes, you would have thought Hermes would just be kind of immune to everything. Its order book is so epic, is softer as well this morning. L'Oreal is down.
Burberry.
Yeah, it's a luxury story. That's where the pressure is definitely coming from.
You're also seeing it in Diageo, for example. You're seeing it in some of the drink makers are underperforming.
The read across
as well.
is kind of there. So they've been the premiumization narrative that they've been pushing so strongly. The idea that they are luxury stocks as well. Everybody's wanted to be a luxury stock. That, I think, is where the narrative maybe comes through. And Asia exposure.
Yeah, and we've talked to a lot of CEOs from the drink space, haven't we, about that theme.
And they've always consistently said, every single one, from Carlsberg to Diageo to Heineken, have all said, Asia's underperforming, but the U.S. is making up for it. And I think that seems to be the trade-off that you're seeing, not just in luxury, but in the broad space. Another thing you're seeing already kicking off this morning, ASML out of the gates, one of your biggest index contributors actually this morning. This, again, comes back to the chip story, the read-through perhaps from Samsung, which, by the way, was named, again, by Jensen Huang, so that's an NVIDIA read-through as well, the Intel investment. But we have shown some that ASML has been underperforming the last couple of sessions, so perhaps this is just a simple technical bounce back as well.
Absolutely. You do wonder whether money comes out of luxury and goes into tech as well. There's probably some portfolio adjustment.
Is there a trade-off there?
I wonder whether there's a little bit of portfolio adjustment that's going on. Lonza's doing well on the back of its acquisition. That's being taken well. Looks like actually the healthcare sector is doing well. SAP's also tracking higher as well. So maybe that point about kind of money coming out and going into the other, maybe there's some element of that. But they do seem to be, these sectors, it's really interesting in terms of the mix, in terms of what is happening. The market can't kind of make up its mind. I know US stocks hit fresh record highs yesterday, but the market feels like it's struggling at the moment for direction, and you're getting one day up, one day down.
So here's an interesting thing. The CAC is still closed, so we don't have movement on some of these big names that we don't have the overall market movement on what's going on in France. And even without that, we see 7 out of the 10 worst performers on the stock 600 have a connection to the luxury story in some way. Either they are straight luxury clothing plays, or they're sort of linked through the drinks route. So that is interesting. It really is a story that does seem to be causing broader sell-off than just those specific issues.
It was really interesting because first thing this morning, the line was, the write-up was, this is idiosyncratic. This is a caring issue. Clearly, it is not a caring issue. Now, I don't know whether this is a fundamental, to your point, the City note, whether this is a fundamental kind of read across from one to the other, or is this just a simple, the algos are programmed to, if you see caring down big, you're going to sell the rest of them. There is always going to be some sort of shadow effect that is created by a movement of this scale. But and we haven't seen, I don't think we've seen caring open yet. So we'll see what that looks like.
Yeah, let's get some perspective on this story. For more on caring, let's join Bloomberg's Angelina Rascouet, who has details of this story. Angelina, we've been trying to get our heads, as the market seems to want to sell more than just caring this morning. We've been trying to get our heads around how idiosyncratic this is to caring and Gucci, and how much this is a story of the wider sector. Give us your thoughts on that.
Well, I think in the luxury space, basically what we've seen over the past few months is that there are winners and losers, and Kering has been on the weaker side because they're in transition mode. Their biggest brand, Gucci, has been in turnaround mode. They named a new management last year. They named a new designer last year. And basically, but Gucci as well is the biggest contributor to profit at Kering. About 2/3 of operating income comes from Gucci. So if Gucci struggles, Kering struggles. But basically, what's been happening is that they blame. So yesterday, they issued a very unexpected announcement saying that current, sales in the current quarter will drop by about 10% at the group level, but even more, about 20% at the Gucci level. But they were quick to point out that so far the new collection that's only hitting the stores, that only hit the stores last month of Sabato de Sarno, this new designer that Guy was mentioning, his collection is still not being widely distributed. So there's going to be some ramp up over the coming months. Yep. But basically, the tricky situation is that Asia Pacific is weak, and it's about 35% of revenue at the group.
Okay, so let's just pick up on that a little bit. Does Gucci have to do anything here other than make sure that De Sarno's stuff is out there? Are people waiting to buy because they're waiting for the new collections, the availability? Is that a problem here? Is this just a timing issue?
I mean, it could be a timing issue. We're going to see over the next few months. Obviously, there's always excitement when you have a new designer. And what happened is that, Alessandro Michele, the former designer, he was known for his flamboyant aesthetic, for, his bohemian chic looks. And obviously, this, there was a cycle and it worked for a while. And then pandemic hit and it no longer worked. Sabato de Sarno, his aesthetic is more, probably minimalistic, elegant, feminine as well. So we're going to see that. But it takes time. And Kering has been very good at saying that, a change doesn't happen overnight. However, we know that investors get, sometimes impatient. So that's what we're seeing right now. But François-Henri Pinault, basically his strategy is he wants, all of his brands, not just Gucci, but to go more up market. Basically, the name of the game is desirability. And you want also to cater to the ultra high net worth individuals whose demand doesn't really waver according to the economic cycles. Aspirational consumers are a big part of the consumers at the Kering labels. And once inflation hit, well, they started curbing spending. But what you want to be in the same category of an Hermès, of a Rolex, where basically demand for your good outstrips, your offering capacity. So that's what he said in February when he announced, full year results, that, part of the plan will be to maybe curb the availability of some products.
So, Angelina, that is the very micro story of what's going on within Kering, within Gucci itself. Broaden this out for us here, because on the one hand, you have the designer story. On the other hand, you have weakness in Asia, and that's something that luxury names broadly have been talking about. Is this ultimately, in terms of the market read-through, just a Kering story, or do we need to kind of read through for some of these other names that you mentioned, LVMH, Hermès, among others?
I mean, obviously today it came as a shocker, so the whole market is falling. I mean, Prada was down 11% in Hong Kong, as much as 11% in Hong Kong. However, Prada has actually been one of the groups that has been doing really well. They have this brand Miu Miu that grew like some 80% in the fourth quarter. So I think there's going to be obviously some winners and losers. If you think about LVMH, they have a wide portfolio of brands. They have the quiet luxury brands. They have the bold brands. And Hermès, as I mentioned, they cater to the ultra high net worth individuals. There's a wait list for their handbags. So I think it's going to be, on a case-by-case basis. And for instance, you were mentioning Burberry. Burberry, we also know that they're in transition mode. They've only had this duo of a CEO and designer for about the past 2 years. But, once also there's a normalization of demand, because we're seeing this right now, those who are in transition mode struggle more than the more established established ones.
Okay, thanks so much, Angelina. Bloomberg's Angelina Rascouret with all the details around the luxury sector. Kering specific, there are elements of that. Read across into the rest of the sector. The market seems to be doing some of that this morning, and maybe doing it because we haven't got an opening price on Kering yet. Kering shares still halted at the open 8 minutes into the trading table. see what kind of weakness we get around that particular name when it opens up. Now, let's broaden our conversation around stocks. The correlation between the S&P 500 and other global stocks has reached its lowest level since 2018. Let's start our conversation there with Joanna Kirkland, Global Chief Investment Officer at Schroders, who joins us this morning to talk equities and much beyond. Joanna, thank you so much for joining us. So I was drawn to this chart, we just showed it on the screen, that shows this breakdown in correlation between what we've seen in the United States and Europe and other parts of the world, India, Hong Kong, and for example. Now, the India story is interesting, and we see that there in the yellow. But Europe has sort of like taken this sort of historic deviation from the US. But we know that the driver here is the Mag 7, and it's all about what the US is doing rather than what Europe is doing here. Is there some kind of Europe catch-up trade, or is that just not possible with this outperformance of AI?
Well, I think, yes, obviously the tech story has been fundamental to the outperformance of the United States. But we also had another important dynamic, which was the fiscal spending we've seen in the States over the last couple of years, which other major areas haven't been able to keep up with. So the growth dynamic more broadly in the economy has been more attractive than other parts of the world. Could that shift? So I think the tech story is a structural issue, but I think that sort of relative cycles could shift as the year progresses. For now, I think the US is quite well underpinned, although interestingly, valuations are more attractive outside the United States. So we've actually been broadening out our exposure for the first time in quite a while.
Yeah, so where does that take you then? Does it take you to Europe? Does it take you to emerging markets? Where do you focus for that catch-up?
The first step was into Japan, like many other investors, and I think, again, the news we had from the Bank of Japan supports that, in the sense of being very cautious in their exit from the very stimulative monetary policy. The weaker yen is very supportive of the Japanese market. Animal spirits are well and good in Japan, so we like Japan. We've been avoiding Europe and emerging markets up until now, but the valuations are quite cheap at this point in time. We do see the potential for rate cuts in Europe as we get through the next quarter. So I think there could be an opportunity for broadening out, particularly given how cheap the markets have got. And ultimately, the growth environment is still quite benign. We have a window here where growth is holding up. There's talk of rates coming down. Inflation for now is moving in the right direction. Things get more complicated as the year progresses.
Yeah, depends how far ahead you look. Yeah.
Yes, exactly.
So the thing we've been hearing, both in the public and the private markets, we had the KKR's head of infrastructure on earlier in the show as well. And the theme we've been hearing over and over again is that Europe is behind in a lot of ways. Anna was talking about it in the markets, but in terms of actual investment, in terms of infrastructure, in terms of growth as well. And therefore, it's best to broaden it out at these cheap valuations. When does that pay off, though? How long before that trade works? Is that a 5-year time horizon? Is that a 12-month time horizon?
The European catch-up. I'm not in a place yet where I can structurally believe that Europe will be outperforming the United States.
Ever?
Well, I think things have to... I think, obviously, Europe has had a more difficult energy picture. You know, at the margin, that is improving. But I think that the growth dynamics are still more supportive in the US than in Europe. So for me, Europe is more of a tactical trade. I like it when I see growth more, you know, a manufacturing recovery, but not a structural trend for me yet.
Talk to us a little bit about the currency read-through here as well. You were talking about the yen, kind of how it's been serving as this carry trade. A lot of focus on the dollar, of course, as it is Fed Day. Happy Fed Day, by the way.
Yeah.
Pretty excited.
I'm thrilled, over the moon. How does the dollar play into the story? Is it even relevant to the equity picture?
Well, it helps. We believe the dollar is still likely to be strong. And again, the move yesterday from the Bank of Japan supports that. I think there were expectations of some more significant shifts that would have shifted the dynamic for the yen and then kind of upended currency markets more broadly. But generally, we've been in the strong dollar camp. That is supportive of Europe as well. You know, euro obviously rallied recently, but ultimately we think the euro should be weakening against the dollar. And generally, that does help the equity market. So tactically, that's supportive.
You talked about a window that we're in right now. It's the Goldilocks window.
Yeah.
Everything's great, fantastic, love it. But you hinted at the fact that that's going to change potentially further as we go further into the year. What's your degree of conviction about what the latter part of the year looks like? How do you, and if it's relatively low, how do you position for a lower conviction environment?
I think ultimately the key to all of this is the labour market. And I think we're still in I think the central banks themselves are unsure about what the relationship is and the dynamics in the labour market. We haven't seen such strong employment markets for decades.
Yeah.
And so I think that the dynamics, how that feeds through to wages, the strength in particular service sector employment, something we haven't seen in a long time, has multiplier effects. So all of that, to me, means that I think at the margin there's a risk that things could be a bit too hot rather than too cold as the year progresses.
So does that mean I'm long fixed income? Does that mean that I'm short equity? What does that world look like from an asset allocation point of view?
I think you still like equities.
Right.
As long as things don't get too hot and then we're back to rate hikes, clearly that would be a very bad outlook.
That's the worst outcome.
But actually, we're in an environment where, yes, you see, the average person doing well through wages, that supports demand. I think that's more of an equity.
Do you like equities to go higher, or do you just like equities not to go down?
We think equity is going up. We still think the path of least resistance is for equities to rise.
One equity that's not rising, we just got an opening price from Kering this morning, dropping 12% after warning around its Gucci sales. Broadening that into your thinking around Europe, I mean, the luxury sector was such a linchpin of the European, in periods of European success, that's oft-cited. Well, today we see the CAC underperforming, down 0.7% versus a only slightly weaker stock 600. Clearly, luxury underperforms today. Where do you put that sector in your outlook?
Well, I mean, we look less at sort of bottom-up stocks from that perspective, but what we are seeing is a very clear sign of a manufacturing recovery. So last year we had service sector outperforming, manufacturing was clearly slowing. We're now seeing a sort of reacceleration of manufacturing around the world. So generally, more cyclical sectors are what we favour.
Nice to see you, Johanna. Thanks very much indeed for stopping by and seeing us. Johanna Kirkland, Group Chief Investment Officer, joining us from Schroders. Kering's now down 13%. There is a read across into the luxury sector. You can see that in this kind of core group that we watch every day, the Sensational Six. There is a read across you can see quite easily into LVMH. It is down pretty hard, but you've got the rest of the sector down as well. It's interesting, Ferrari actually not down as much. ASML, Novo Nordisk both rising, so I wonder if there's a money rotation story into those two stocks as well this morning. Let's find out what else is moving. Joe's got all the details.
So here's that 13% drop in Kering at the open. As you can see, I was looking on the terminal. It looks like the biggest drop since the start of the pandemic 4 years ago. I'll have to check that size of scope in a minute. But we're seeing a swathe of other stocks dropping. You mentioned LVMH, Hermes, Burberry. My colleagues on the stocks team trying to calculate the total loss in market cap. It's going to be several tens of billions, according to them at the moment. Here's a few more stocks for the same reason. Christian Dior, Richemont, Hugo Boss, earnings coming from them tomorrow. And Bruno Cucinelli. We've got many stocks that we could bring up to show you, given this drop in Gucci sales, mainly in Asia, as you've been discussing there. We're going to have a quick look at UK stocks, though, because we did have that inflation data. It is easing. We are seeing a bit of a boost in some of the home builders. Taylor Wimpey getting a boost up around 1.5%. But there's other stories in the UK. Computer Centre, a maker of logistics technology, about a 3 billion market cap. They've got some weak earnings as their pandemic boost continues to fade. Prudential getting a bit of a boost in line with its Hong Kong shares. That's the insurer, seeing a big rebound in China earnings. And we got a share placing on Trustpilot, the website. That's down 5%. At a discount, it was 200 pence a share, and we're coming below that, 198 on that one. Just a couple of morning calls to bring you. We've got one on BASF over in Germany. This one gets an upgrade, and it's over at Berenberg, who says that the biggest drop in chemicals volumes in decades is a reason to see the bottom and start buying chemical stocks. So they like BASF. And we'll bring you one more on the screen. We're going to flip over to that one, and this is Banco BPM. This one is over at Citi. They're a buy on that one. They think there could be consolidation in the Italian banking sector. Bit of an interesting angle on that one, and that one is gaining 1.4% this morning.
All right, Joe Easton from our equities team, we thank you so much. And then just finally, price quick check on that Kering story, continuing to drop down about 14%, even below its street low. Coming up on the program, ECB President Christine Lagarde due to speak at a conference in about 30 minutes' time. We're going to preview that speech next. This is Bloomberg.
Names in tech are on Bloomberg.
There's a natural tension
between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back. This is Markets Today. 21 minutes into a European equity session that's dominated by the luxury sector, and that domination coming through in the French market, down by 0.9%. A considerable weakness around the Kering share price, dropping 12% or so at the start of the trading day, and continuing to move lower this morning. We can continue to monitor what's going on in that luxury sector. Let's step away from the micro and back to the macro story in the UK and in the broader European story as well. Traders have added to Bank of England rate cut bets after UK inflation fell more sharply than some had expected, apparently. That's pushing the two-year gilt yield lower, nearing the lowest levels seen since January. Let's get to Lizzie Burton, who can clear this up for us. Lizzie, break down the data for us, because, yes, the data dropped. It's moving in the right direction as far as the Bank of England is concerned. But my reading was that some of it came in a little higher than had been expected, and that services number, maybe there's some concern there. So break down the data for us.
Yeah, you're exactly right, Anna. It's 2 out of 3 marks of good news. So you've got the headline level coming down more than the Bank of England and the consensus had expected. This is because of food prices and costs in restaurants and cafes. Then you've got the core number coming down more than expected as well. But it's the services number, as you say, that's the worry here. And the reason it's a worry is because it's an indicator of domestically driven inflation. And this is the main thing that the Bank of England's concerned about, when it doesn't want to cut rates too soon, doesn't want to have to reverse to hiking again. You've got the pound down 13 basis points at $1.27 off the back of this. So it didn't get an immediate reaction, but you are seeing a knock to the pound now.
Well, Lizzie, connect those dots for us for the BOE then. You mentioned it a little bit. Walk us through what's actually getting priced in now. Does this change the game in terms of how traders are viewing that decision?
It doesn't change the narrative, Critty, but it has changed the pricing slightly. So you've got traders now pricing in 71 basis points of cuts versus 67 earlier. So it's an increase, but not much of a change. It still shows that traders are fully pricing in 2 rate cuts this year, a third very much in play as well. But City economists are saying already the Bank of England is behind the curve when it comes to cutting. It's already too late. And when we look to tomorrow's meeting, yes, we're expecting a hold, but I don't expect that we'll get too much hinting as to when that first cut is going to come. I would keep an eye, though, on the vote split. Do we get a more dovish vote split? Do we get some of the hawks, like Jonathan Haskell, actually dropping out of the hiking camp? Probably not Catherine Mann. She's just had a second 3-year term confirmed on the Monetary Policy Committee. But if you do see a surprisingly dovish BOE, HSBC's warning that the pound is increasingly vulnerable here.
Lizzie, it's not just the service inflation that is increasingly in focus. I look at the PPI numbers as well, and it's interesting to see kind of what's happening there. I think that's something that's maybe going to be a focus on as well. Lizzie, great stuff. Thank you very much indeed. Lizzie Burden joining us ahead of the BOE on that data that we've got this morning on CPI. The next event we're watching is surrounding the ECB. So we're going to be hearing from a host of Governing Council members at the ECB. It's this Watchers Conference. It's in Frankfurt today. The main event, of course, is Christine Lagarde speaking very shortly. We'll bring that to you live. To kind of set that up, Zoe Schneeweiss joins us, our Western Europe economy editor. Zoe, the message from the ECB is we need more data before we make that message in June, before we potentially deliver a cut in June. What is Lagarde going to say to add to that today?
So Lagarde hasn't spoken in the last 2 weeks since she delivered the rate decision where they held rates and then said that and hinted very strongly that June would be the month to act. Since then, we've had a number of wage measures that came in. So the one reason why the ECB is delaying is they say they want to be sure that that slowdown that we've seen in inflation, and just as a reminder, in February, euro area inflation was at 2.6%, so quite close to that 2% that the ECB is targeting. They need to see that wage data then, that wage agreements that come in in the first quarter don't then push up inflation again. So we've had several wage readings since then. So anything she'll say would just be against that backdrop that we just have more data. So even if she repeats exactly what she said 2 weeks ago, it still will mean that those wage data that the ECB is happy with those wage numbers. And that is significant. Lagarde is one of many speakers, as you mentioned. We've also got the chief economist chairing a panel. We've got Isabel Schnabel, who heads the markets team, who is an executive board member, also speaking. And then we've got the Spanish central bank governor, Hernández de Cos, also speaking. He, as we know, is more on the dovish side. So he will, if he sticks with his language, that June cut, he will be mentioning as well.
All right, Bloomberg's Zoe Schneeweiss in Frankfurt. We thank you so much for walking us through that story. And of course, she will be speaking at 8:45 a.m. UK time, so we will bring you that speech live here. Really interesting that's going to come on Fed Day as well. And this is going to be exciting for euro, dollar in particular, which hasn't really been able to crack that 107 level.
We were already excitedly watching the other side of the dollar-yen trade. Now we get to watch euro-dollar as well, with both participants in play.
Yeah. It's interesting she's kind of inserting herself just before the Fed. Anyway, we're going to talk Bitcoin next. Is that a Fed-related story? Michael Schonenstein, the CEO of Grayscale, is going to join us next. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie going begets movie going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
For 2024, we are a little bit more cautious. There are a couple of challenges. The macroeconomic environment, I think competition also increased even further. We have also some supply issues. We still have some supply issues. That's why we are a little bit more cautious. We expect our return on sales to be between 8 and 10% at the moment, and our net cash flow to be between 2.5 and 3.5 billion euros.
The Audi CFO there speaking to Bloomberg Television at the same time, of course, as we are monitoring a lot of that. This is, of course, Marcus Say. We're 30 minutes into the European trading day. We have a big eye on Kering here. The shares are down about 14%, dragging the entire luxury sector, potentially at one point seeing its biggest intraday drop since the COVID sell-off about 4 years ago. That being said, it has since pared some of those losses and kind of bouncing around. You're seeing quite a bit of volatility, but for me, I think the takeaway is trading about 366 euros a stock. That is significantly lower than the street low by Goldman Sachs on the stock.
That's an interesting one. And once again, we're back to talking about whether there is this read across. It's becoming increasingly apparent as we go through the morning that maybe this isn't just specific to Gucci and to Kering.
I just think we don't know.
Right.
And that's the point. So maybe this is a big name that is struggling, and if a big name struggles, there is going to be some sort of gravitational effect on the rest of the sector. That seems logical to me. I think they need to give us more details as to what is going on, or others need to give us more details. I'm going to make a pivot to Bitcoin now, which is going to be an interesting pivot. And the reason I'm doing this is because there's been a huge pickup in demand recently for luxury watches as we've seen this rise back up again in Bitcoin. So the two, I think that there's a degree of correlation that comes through between Bitcoin and luxury. That clearly isn't affecting Kering this morning. But Bitcoin coming off a little bit recently, retreating. Investors try and digest what this recent rally means. You're also seeing, obviously, the work through of how we have moved from kind of the non-ETF environment into the ETF environment, which takes us to our next guest. We have seen one of the big themes post the ETF launches is a big outflow from the Grayscale fund. And what we've now got is potentially Grayscale launching a kind of mini fund, which will have lower fees, we understand. We need to get some details on what is happening here. The perfect person to ask around all of this, of course, is Michael Sonnenschein, Grayscale's CEO. Michael, great to see you.
Great to see you.
Great to see you in person, which is fantastic. I think you and I have met many times down the line, but nice to see you here in London. Look, we'll deal with the ETF in just a moment. First of all, talk me through your view of the recent price action. What is going on here? We're seeing a little bit of a roll-off. Is that Fed-related? Is this that because we've come too far related? What is going on?
Well, I think we have to just examine where we've been over the last couple of months. It wasn't long ago that we were in a crypto winter, and as crypto winter melted, prices started to accelerate. Around the time spot Bitcoin ETFs got approved in the US, many called it a kind of sell the news event. And on the back of that, we've seen unprecedented demand for spot Bitcoin ETFs in the US, which has been a real driver of Bitcoin prices. We broke through that all-time high just a couple of days ago, all the way up to about $73,000 US dollars for the Bitcoin price. And now we're seeing that, come down a little bit, which is healthy. Bitcoin does this from time to time. Investors understand that these pullbacks are normal, healthy, expected, and we're still up over 50% year to date.
When all the ETFs launched and when we saw GBTC convert, I spent a lot of time with Katie Greifeld, who was very obsessed with fees, as you well know, surrounding all the various ETFs and trying to track the impact that those fees potentially had in terms of outflows. We've continued to see outflows coming out of GBTC, and I'd be interested to get your take on this going into other ETFs. You are now launching a different version of that fund with lower fees. And the question, therefore, that everybody's scratching their head about is, why don't you simply just lower fees on the original fund and potentially stem some of the outflows?
Sure. Well, this is a really important question, and this is on a lot of investors' minds, so I want to, attack this head on.
Yep.
When GBTC uplisted to the New York Stock Exchange, it did so in an unprecedented way. It had $28 billion of assets under management, a 10-year track record, and a very diversified shareholder base. And when we look at that in the context of the ETF wrapper, anytime you've seen a new exposure, a new offering type, fees tend to be higher, and over time, fees come down as those markets tend to mature. Now, again, it's only been about 8 or 9 weeks, right? Which, in crypto is kind of like 2 years, but in the real world, it's only about 8 or 9 weeks. And so this market has matured and has come in faster and more furiously than any of us could have anticipated. So it has always been our intention to lower fees on GBTC over time as that market has matured. As you said, we also did recently file for the Grayscale Bitcoin Mini Trust, which will come to market given regulatory approvals with a lower fee and really give investors the opportunity to have greater access to this ecosystem, allow for Grayscale to have both kind of its flagship GBTC offering as well as that mini kind of core allocation offering through ticker BTC, again, if we get regulatory approvals for the product.
So lower fees over time, which, to be fair, is a mark and shift in thinking and what you've said previously. What's the catalyst for that, though? What do you need to see to say, all right, now we have to make that move?
Well, I wouldn't say it's a shift in thinking, more so something that's kind of always been on our roadmap. When we look at, again, historical, prices and the way that markets have matured, it's usually taken quite a bit of time for those new products to come to market, get saturated. And I think for us, when we zoom out, given it's only been 8 or 9 weeks, we're just at the end of that first inning of satisfying that initial demand before that next wave of growth will happen, where we're talking about platforms, financial advisors, registered investment advisors, private banks, first getting comfortable and onboarding some of these products to their platforms. And we think that could be the driver of this next wave of adoption of spot Bitcoin ETFs.
Good morning, Michael. So is the answer then that you think you can be a price setter and you don't have to be a price taker in this market?
Well, again, prices certainly will come down over time. I think a lot of the new issuers were trying to lure new investors into their products, starting from scratch, with no track record, no assets, no AUM. And we will, see those products continue to emerge as time goes on. But you are seeing a little bit of a cohort amongst the Grayscale product, the Fidelity product, and the BlackRock product, really taking kind of the liquidity position within the market.
Let me ask you a sort of step back question around the way that crypto, blockchain fits into some of the other big tech trends that we've been talking about. Clearly, there's so much excitement around AI right now, and perhaps that detracts a little bit from some of the faster money that might have gone into crypto, and maybe it's chasing some of the stocks that do well out of AI instead. But I wonder if you link the two. Some people talking to me about how blockchain could have an opportunity with the AI era around validation and verification, and that's an interesting area to watch. How does that sound to you at Grayscale?
It's actually an area that we're very focused on and very excited about. We feel that AI and crypto have been really two technologies that have been growing independently of one another. And now that AI has become a little bit more mainstream, we're starting to see adoption and usage, but we're also starting to see some issues with AI, things like bias and deep fakes. And when we think about the technology that underpins many crypto assets, blockchain, it can actually serve to ameliorate some of those issues that we're seeing in AI. And so as we move into this next era of adoption, we actually could see how these two technologies could actually symbiotically grow together rather than continuing to mature as independent technologies.
So you talked a little bit about how the demand for the ETFs is driving the price higher. Let's talk about it in reverse. There is a halving coming up. Are you concerned about the read-through into ETFs at a time when products like yours are seeing so much momentum?
Well, my team has always led with investor education, and given that the introduction of spot Bitcoin ETFs have really been almost Bitcoin's mainstreaming moment, we're going to use this upcoming halving, which I think is only about 30 days away, as a reminder for us, for the investment community, to really dive back into the fundamentals of Bitcoin, that this halving is baked into the Bitcoin protocol. This is an important part of helping investors understand the verified supply, the constrained supply that underpins Bitcoin. And I think a lot of investors are going to not only focus on that over the next 30 days, but also see how it is a catalyst for prices in the months that follow, like it historically has.
Michael, in theory, the whole crypto space should be an uncorrelated asset. Doesn't feel like that right now, does it? We've got a Fed meeting coming up a little bit later on today. As you look at the relationship between Fed and Bitcoin, the Fed decision and Bitcoin, how does it change the reason for me putting it in my portfolio? Is this an uncorrelated asset? What role does it play in my portfolio if it is still correlated with the big macro events that we're watching?
Well, there's no question that if you look across asset classes, there's certainly been a convergence around correlations. And so what we're hearing from investors is that if they want to beat their benchmarks, they're going to have to start diversifying as assets get increasingly correlated. And that means diversifying into new asset classes like crypto. I certainly think, and the Grayscale research team has really done the analysis to believe that for many investors, an allocation of maybe up to 5% of their holdings, their investable assets in crypto, may make sense for investors with the right risk tolerance. However, in the context of the Fed meeting, we do believe that if those rate cuts are actually going to happen later this year, that could actually be quite bullish for Bitcoin prices.
Okay, Michael, really nice to see you. Thanks very much for coming to see us while you pass through London.
Thank you.
Michael Sonnenschein, the Grayscale CEO. Just a quick word on another area of tech. We've got numbers coming through from Tencent, the China-based technology company, missing estimates when it comes to net income. The revenue number also looking a little bit light of estimates. We'll delve into the details here, but needless to say, one of the big shareholders that's here in Europe in Tencent, that is Prosus. That stock now down by 0.4%. It was previously up by around 0.8%. So we'll keep an eye on that sector. Coming up, we'll get back to the macro themes. Christine Lagarde is due to speak in the next few minutes. We're going to bring you live pictures from a university in Frankfurt, where she is speaking. The ECB president will be, she will be speaking from there. Full coverage of that shortly. This is Bling Bang.
Over the last year.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
So the ECB Watchers event is underway in Frankfurt. Christine Lagarde is currently being introduced at the Goethe University where the event is being held today. When she starts speaking, we will bring you that speech live. It comes obviously in advance of what we're going to be hearing from the Fed a little bit later on. Interesting that this all comes on the same day. The expectation is that Lagarde will probably point to the idea that we are waiting for more data at the ECB before we make a decision in June.
Yeah, waiting for more data, in particular around wages. That's been a big theme, hasn't it? And yeah, I was drawn to that report we had earlier on the Bloomberg terminal saying that we'll get more insight into the types of wage data they are looking at themselves at the ECB, and that'll be something to watch in the days and weeks ahead.
We're going to keep a real close eye on the FX story, though, because already you're seeing quite a bit of volatility in euro-dollar this morning. 108.53 there, cable at about 127, we'll call it, and that's all in front of what the FOMC is going to do and what Chair Powell might say to move what everyone's saying is going to be a long dollar trade.
The ECB is still pushing back on this idea that it's not dependent on what happens with the Fed. Everything feels very dependent on what happens with the Fed.
We are not Fed or date dependent, to paraphrase de Guindos.
Date dependent, not data dependent.
Yes, exactly. We are not date dependent. Yes, exactly. We're not date dependent, and we're not Fed dependent, and certainly not the 13th district.
The fact that they keep having to say it probably suggests maybe they are a little bit.
We just keep asking this really annoying question, don't we? Maybe it's our fault.
They really do. I mean, look, for me, it's going to be, I mean, you mentioned the wage tracker data from the ECB as well earlier in the program. There's a lot of read-through in terms of are the U.S. and the EU, and the ECB, excuse me, US and the EU, that's the right comparison. Are they on the same page, or do you see this divergence? Because a couple months ago, the question was, these are two central banks that are really going to diverge, and now you're actually seeing the opposite. The timing actually lines up almost perfectly in terms of the guidance that these two central banks are giving.
Does it, though? The market's only pricing 50-50 for June now for the Fed. Like, it's not going to take that much of a shove, maybe, for them to get out of sync.
That's what the markets are pricing, and that's not what Powell and Lagarde have told us.
No, that is very true.
Okay, we're still waiting for this speech by Christine Lagarde to get underway at this institute. We are, of course, hotly anticipating what she has to say. We've got a few news lines coming through already around her speech, but we'll wait for further details on that. We need to move further along the disinflationary path, and that just speaks to what we've been hearing for a long time from both the ECB and the Fed around needing to feel more comfortable. Also going on to say they're watching wages, watching profit margins and productivity growth. So there's the wages focus once again. Interesting on the profit margins. That's something you flagged a few times, that it's interesting that the ECB is watching that.
You never really see a central bank talk about the corporate story as much, but the profit margins has a lot to do with the regulation piece of it as well, because higher profit margins means that they are passing on extra costs, especially if you see in the PPI data, to the consumers. That ultimately hurts the consumer. That disincentivizes spending and therefore hurts growth in theory. That's interesting. The productivity growth is interesting too, because that's an AI story. Everyone's watching what the AI, the tech kind of transition means for labor force participation, for productivity, and that seems to be in the ECB's view as
Yeah, it was really. I was at a conference yesterday, and we were talking about AI and where it delivers on productivity, and there was a lot of conversation around how it maybe is going to deliver on the micro front, but they're not. We're waiting to see it deliver on the macro front, waiting to see where and when specifically it can really kick in on macro level, and that's going to be in focus. We're going to hear more from Christine Lagarde around wages. That's certainly the case.
It sounds like I understand that she is being introduced right now. So Christine Lagarde is about to speak. Is she going to set the tone? How will what she says in potentially change the positioning story going into the Fed? I think will be interesting to see today. Looking at the comments that are already coming out, services inflation may remain elevated for most of the year is the latest line that I'm seeing as well, coming in advance of what she's about to say.
Yeah.
Does she change the narrative, or can she change the narrative going into the Fed? I think is interesting.
The positioning story it caught my eye as well. We talked about the FX piece. The bond market matters as well. Remember, Japan has been closed for a little bit. Europe only opened for about 48 minutes in terms of the bond market there. So you could actually see a faster reaction in the bond story.
Okay, we understand that Christine Lagarde, president of the ECB, is making her way to the stage. We can see her just there, the ECB Watchers Conference taking place at a university in Frankfurt. Here she is.
Thank you very much, Professor Wieland, and thank you for sitting next to me. It's nice not to be alone on this wide podium in front of this respectable audience. Very large number of men in this room, if I may say. Sorry, couldn't help it. But I'm delighted to be back here in front of you for this 24th conference of the ECB and its watchers in an environment that I will not bother to describe because you've done that beautifully, Professor Wieland. And all I will say for our own purposes is that we are not in a less threatening environment from a geopolitical point of view, far from that. And if we have settled some score with inflation, we are looking at the world, and I think it goes beyond even the places that you've mentioned. If we look at other places, notably in the Republic of Congo and other places where war is just ramping around, which, as we all know, is probably the most adverse event to derail growth, to unsettle societies, and to cause great, great damage, as we will be learning fast in relation to Ukraine. And I agree with many of the comments that you've made in that respect. Not that it would matter for inflation, of course. Well, it does, actually. But anyway, what I would like to do this morning with you is reflect on the journey that we have traveled in the last year and a half or so, and describe for you what I regard, together with my colleagues and friends, members of the executive board who are present in the room, and my colleagues from the Governing Council who are also here today and will participate in panels, as the three phases that we have navigated or are navigating or will be navigating. So bear with me. Some of that will sound terribly familiar because we have already, all of us, and you certainly have, dissected the first phase in particular and are dissecting the second. But I think that to see things in perspective actually helps understand where we are and what we are planning for the near and more medium-term future. So since the pandemic, we monetary policymakers have been facing an exceptionally complex environment. As inflation rose, we were confronted with profound uncertainty about how far it would go, how widely it would spread, and how deep it would dig. And even as inflation has eased, uncertainty about its persistence has remained. The potential costs of miscalibrating policy have been high, which is why we had to employ a policy framework that minimizes the risks of mistakes. And we have done so by building up a framework and our reaction function around three criteria that you are familiar with. One is the inflation outlook, the second is the dynamics of underlying inflation, and the third is the strength of monetary policy transmission. Though we conceived these criteria when we had low visibility of future inflation, they have also helped guide our decisions as inflation has fallen and forecasts have become more accurate. As Marie Curie once said, to thrive through the ups and downs of life, we must have perseverance and, above all, confidence. And our framework has indeed encouraged us to persevere when necessary and to build confidence when needed. It has served as a reliable compass for calibrating policy through 3 phases of our current policy cycle. First, it helped create robustness during our tightening phase when we were devising how far we needed to go to rein in inflation. Second, it has helped us practice patience during the holding phase until the signals from our inflation projections and underlying consistent are more consistent. Third, it will support us in building up sufficient confidence to begin the dialing back phase in which we make policy less restrictive. So let's have a look at the tightening phase, which is the first one that some of you have observed very, very closely.
Connection lost.
In the early phase of our tightening cycle, our main priority amid surging inflation rates was to exit our accommodative policy stance as quickly as possible. While the policy challenge was immense, the policy path was relatively simple to calibrate. But as rates rose and approached restrictive territory, calibrating our policy stance became more complex. We first had to assess how much rates needed to rise until they were sufficiently restrictive, and then for how long they needed to stay at that level. But our assessment was blurred by much lower than normal visibility of the future. Our forecast repeatedly under-predicted inflation by large margins, even at shorter horizons. From 21 to 22, for example, the absolute inflation forecast errors in the staff macroeconomic projections, despite their best efforts, 1 quarter ahead, was more than doubled, largely owing to volatile energy prices. At the same time, the mix of shocks that emerged from the pandemic and its aftermath, and I will list them, I'm sure you can add a few, but I will try. Rotations in spending, energy spikes, particularly gas, bullwhip cycles in the manufacturing, supply bottlenecks, tight labor markets, fiscal expansion, reopening effects, and I'm sure you can add a few to that list. But that mix of shocks heightened the risk of inflation becoming more persistent. We faced a highly unusual conjuncture of high inflation and declining real wages, but also, at the same time, rising employment. And this combination essentially implied a multi-year catch-up process to make up for real wages loss. And in turn, and I spoke about that phenomenon last year actually, this could have triggered what are referred to as the tit-for-tat inflation dynamic. And we faced uncertainty as to how quickly and forcefully our monetary policy response would succeed in bringing down inflation. The ECB had not been through a tightening cycle for more than a decade. And there were reasons to believe that the transmission of monetary policy to firms, to households, might have changed. Take the prevalence of fixed-rate mortgages as a point in case. So to calibrate policy accurately, we needed a framework for policy decisions that would work when we had low visibility and that would mitigate heightened uncertainty. This is why we built our monetary policy response around the 3 criteria that I referred to earlier: the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. And this approach made our decision more robust, as the inflation path we foresaw in our projection had to be validated by data. And data that we could observe in real time and that we could extrapolate into the medium term. That required a bit of an intellectual effort, by the way, and I'm glad that we were able to do that. But that in turn enabled us to take forward-looking decisions with a much higher degree of confidence. And it served us well in practice. The three criteria helped us map out the remaining climb, allowing us to bring rates to sufficiently restrictive levels to break the persistence of inflation, but also by guiding us to carefully evaluate the strength of policy transmission. So this helped us reach the decision to stop rate hikes in September. That takes us into the second phase, which is the holding phase. The one that we are now in the current phase of our policy cycle, which is a phase during which we committed to keep rates at restrictive levels for as long as necessary. Since the start of this phase, inflation has been declining consistently, and our projections have been showing inflation returning to our target over the medium term. We now project inflation to average 2.3% in 2024, and we then expect inflation to decline to 2% in 25 and 1.9 in 26. And I mentioned those numbers with much more confidence. Unlike in the earlier phase of our policy cycles, there are reasons to believe that the expected disinflationary path that we have observed will continue. Why? Well, first, for some time now, inflation outturns have been broadly in line with our expectations. Broadly. In 23, we saw a reduction of about 70% in the average absolute error in our staff projections relative to 22, 1 quarter ahead. Second, we now see inflation returning to 2% earlier in our projection horizon than before, mid-25, and not exceeding our target for the remainder of the horizon. Third, the composition of inflation is improving as we now expect lower core inflation in the medium term. And this suggests that the convergence to 2% is likely to be more durable and less beholden to assumptions about commodity prices, notably, although the commodity prices can always prove hazardous. The other criteria are also becoming more consistent with this improved inflation outlook. The transmission of our monetary policy is unfolding in the right direction. Financing conditions have reacted strongly to higher rates, loan demand has weakened, and in turn, activity has slowed notably in the most interest-sensitive sectors of our economy. And underlying inflation is generally easing. Nearly all the measures that we track are declining, and the range of readings between the different measures has narrowed from 4.1 percentage point at its peak to 2.4 percentage points today. Some of the measures of underlying inflation with the best leading indicator properties for future inflation have dropped significantly. So, well, at the same time, domestic price pressures remain strong. Services inflation is still stubborn and hovering around 4%, while momentum increased somewhat in February. And our indicator of domestic inflation, which measure items with a low import content, stands at 4.5%, at the top of the range of underlying inflation measures that we monitor. And this measure as well has been found to have good leading indicator properties. So why is that? Well, these pressures largely reflect robust wage growth as the catch-up process continues, as well as a tight labor market that has so far been resilient to the slowing economy. Employment grew by 2 million cumulatively during 2023, even as the economy stagnated, while firms continue to hoard labor. This pattern is mechanically lowering labor productivity and pushing up unit labor cost. And at this stage, it is difficult to assess whether these price pressures simply reflect the lag in wages and services prices and the pro-cyclical nature of productivity, or, that's the other explanation, whether they signal persistent inflationary pressures. So although we have made significant progress in all three of our framework criteria, we are not yet sufficiently confident that we are on a sustainable path towards our inflation targets. And that takes me into what will be the third phase. The essential question is, what do we need to see? What do they need to see is the question that I occasionally see. What do we need to see to become sufficiently confident to start dialing back our restrictive policy stance? Well, put simply, we need to move further along the disinflationary path. And there are three seems like a magic number, three domestic factors that will be decisive to ensuring that the inflation path evolves as we project it. And I'll take each of the three briefly. The first factor, as you can imagine, is wage growth. Our forecast sees nominal wages slowing to 3% over the next 3 years, allowing real wages to fully catch up to pre-pandemic levels over the projection horizon, also including productivity gain. But with the unemployment rate expected to remain very low at 6.6%, this wage path cannot be taken for granted. Sensitivity analysis by ECB staff shows that if there were an earlier full catch-up by the end of this year, 24, inflation would rise to 3% in 25 and only fall to 2.5% in 26. This is sensitivity analysis work. The second factor that we will be looking at very carefully is profit margin. The compression of profit margin of late has allowed wages to catch up without further accelerating inflation. Unit profit accounted for more than 50% of the GDP deflator in the last quarter of 22. Fast forward to the last quarter of 24, this figure is down to 20%. But again, our sensitivity analysis shows that if firms were to regain pricing power as the economy recovers and profit margins were to rise by an accumulated 1 percentage point more than we project until the end of 26, inflation would be at 2.7% in 25 and 2.4% in 26. To the sleeping lawyer inside myself, it says one thing: antitrust authorities better get their act together and make sure that concerted practices, market sharing practices should be fought as much as possible. The lawyer goes back to sleep. The third factor that we will look at is productivity growth. Hello, Professor Ising, it's lovely to see you. So the third factor that we will observe is productivity growth. We expect that a pickup in demand, if accommodated by fully utilizing hoarded labor, will lead to rising productivity growth and falling unit labor cost. We project labor productivity growth of 0.1% this year, before it rises to 1.2% in 25 and 26. But the path of inflation could be different if, in a new geopolitical environment that you have referred to, Professor, productivity losses for European firms turned out to be partly structural. And there will be a fascinating panel with my colleague and friend, Mrs. Schnabel, Professor Schnabel, I should say, this afternoon on these issues of structural reforms. On this particular point, by the way, the competitiveness desperate search that we are conducting in Europe at the moment is also fundamental to that particular point. Given the delays with which these data become available, we simply cannot wait until we have all the relevant information. If we were to do so, we could risk being too late in adjusting policy. But in the coming months, we expect to have two, not three, two this time, important pieces of evidence that could raise our confidence level sufficiently for a first policy move. So let me take each of these two. First, we will have more data to confirm whether wages are indeed growing in a way that is compatible with inflation reaching our target sustainably by mid-25. And my great chief economist, Philip Lane, mentioned to me this morning that we are getting numbers that are heading in the direction that we expect. And that is good, but not enough. So the latest data point in this direction. Growth in compensation per employee edged down to 4.6 in the fourth quarter of last year. So Q4 23, 4.6, slightly below our March projection, but from a 5.1 percentage point during the third quarter of 23. That's for CPE. If we look now at negotiated wage growth, which accounts for the lion's share of compensation per employee growth, it also decreased from 4.7 to 4.5 in the last quarter. Similarly, because we try to have as many indicators and measurements as possible, the ECB's not backward but forward-looking wage tracker, which anticipates the development of negotiated wage growth in the euro area, is also showing some early signs that pressure is beginning to ease. Average growth, wage growth in 24 for all existing wage contracts fell from 4.4% at the time of our January Governing Council meeting to 4.2% at the time of our meeting in March. This coming months will help us form an even clearer picture and understanding. We will receive data on negotiated wage growth in the first quarter of this year at the end of the month of May. And many wage negotiations are currently taking place in large sectors throughout Europe, the outcome of which will be entered into our wage tracker as soon as negotiations are concluded. Employees whose contracts ran out last year and have not yet been renewed or will run out by March 24 account for around 1/3 of those in our wage trackers. So that was the first piece of evidence that we are observing very carefully. Second, by June, we will have a new set of projections that will confirm whether the inflation path we foresaw in our March forecast remains valid. These projections will also implicitly give us more insight into the path of underlying inflation. We will have more visibility on the strength of the recovery and the likely direction of the labour market, and therefore on the consequences on wages, on profit, and on productivity. In addition, we will have had a longer window to assess whether inflation data continue to fall broadly in line with our projections. If they do, we can be more confident that our models are now more accurately capturing inflation dynamics. And this confirmation will be particularly important for the more persistent components, such as services, so that we can trust that these components will continue to decline in keeping with their typical lagging pattern. If this data reveal a sufficient degree of alignment between the path of underlying inflation and our projection, and assuming, of course, that transmission remains strong, we will be able to move into the dialing back phase of our policy cycle and begin making policy less restrictive. But thereafter, domestic price pressures will still be visible. We expect services inflation, for example, to remain elevated for most of this year. So there will be a period ahead where we need to confirm on an ongoing basis that the incoming data supports our inflation outlook. So this has two important implications for the policy path ahead. Two important implications. First, our decisions will have to remain data dependent and decided meeting by meeting, responding to new information as it comes in. This implies that even after the first rate cut, we cannot pre-commit to a particular rate path, however tempting that is, however much some of you would like to see it. If we are honest to our methodology, and if we have discipline in adhering to these principles, we cannot. That was the first important implication. The second important implication is that our policy framework will remain important to process the incoming data and calibrate the appropriate policy stance. Inflation outlook, dynamics of underlying inflation, transmission of monetary policy. But at the same time, the relative weights assigned to the three criteria will have to be regularly examined. So, in conclusion, I said after our last Governing Council meeting that when it comes to the data that is relevant for our policy decisions, we will know a bit more in April and a lot more in June. I hope that my remarks today and the developments that I've taken you through will help understand our analysis, our logic, and our method. So in the coming months, we will receive more data, which will help us assess whether we are sufficiently confident in the path ahead to move to the next phase of our policy cycle. I thank you for your attention.
Well, welcome to The Pulse. I'm Francine Lacqua here in London, and you've been listening to the ECB President Christine Lagarde giving her one of the main keynote addresses of the year from the Goethe University in Frankfurt for the ECB and its watchers. Now, the European Central Bank, she said, cannot commit to further reductions in borrowing costs after a likely move in June. Now, this is a big speech. She basically said that when it comes to the data that is relevant for our policy, she says we will know more by April. That's wage negotiation month, and a lot more by June. Beyond that, she says there's not much that could be said. If you look at the initial reaction to the markets, I think we have euro, dollar, but we could also look at the Germany front-end bonds, shrugging off some of the remarks that Madame Lagarde had said, because some of them were actually reiterations of remarks she made previously, including at the last ECB policy review. Now, to talk about all of this, we're joined by Anneke Trojan, Chief Economist at Van Lanschot Kempen, also with me, Bloomberg's Noor Al-Ali. So thank you both for joining us. Noor, we were listening to this together. I mean, she basically tried to give a little bit of an idea to the markets on her thinking once again. I think the 2-year German yield fully pricing in for an ECB rate cut in the summer, and then many question marks going forward.
Yeah, absolutely. What was interesting to me is that Madame Lagarde seemed a lot more confident when it comes to the inflation story that we've had in the last couple of years out of the euro area versus, just her last speech last year at this same conference. So I think there's a lot of optimism that I think is baked into this. As she was looking, I was looking at swaps that are tied to meeting dates. And those are the kind of swaps that look at or are betting on when the ECB will cut rates. They're pretty steady. We're looking at 20 basis points by June, so still not fully pricing that. But, by July, we're looking at 36, so really sealing that view. But so the market is still expecting or is putting in more weight to an ECB June rate cut compared to the Fed and the BOE, even after the softer inflation print that we had out of the UK. So it's all pointing to, signs that, inflation is headed in that right direction. It's just taking some time, and that wage data that you mentioned is really key for ECB policymakers, as they've repeatedly said.
So, Annika, what do you make of the speech? Again, it seems that the timing of the first actually reduction is increasingly clear, but then from June onwards, many more question marks.
Yeah, and I think what she's doing very well, and other policymakers are doing this as well. I think central banks have learned to really hold the hands of markets and market participants in guiding them, managing their expectations. And I think the two things that she managed again this morning was, number one, the visibility is very unclear. So even after the first cut, don't expect that by definition the next one is coming. It could even be a pause or even a longer pause. And number two, in terms of the timeline, like you said. But it's, I think, also as mentioned just now, it's for Europe especially, it's all about wage inflation. And that's the biggest dilemma that all European economists have. How is it possible that despite such a sluggish growth economy, the labor market is so tight, wage inflation is so tight, and it's all about demographics, and that's Europe's biggest problem, which makes this complicated.
Yeah, and Annika, I know that, Christine Lagarde, again, reiterating that they're basically data dependent. So she's looking at wage growth, she's looking at productivity, she's looking at corporate profit margins to determine when rates can be lowered. But it's difficult for the markets given the repricing also of the Fed. So if you're a trader right now and you're trading German bonds, do you look at the Fed to give us an indication of what Christine Lagarde does?
I think so. And, one easy comment is, well, Europe always follows the US, but obviously that's a bit too straightforward. But it again boils down to the wage inflation story. The wage inflation issue that Europe has is much more complicated than in the US. The US, they've managed to beat the inflation fight, so to speak, right, with inverted commas. The economy is strong. They're able to pull through and they're able to proceed. Europe is more complicated, so it's only natural and logical that the ECB would want to wait a little bit longer, also see how markets are reacting, see how the path in the US is progressing. So that's something which I think would be a reasonable thing to expect. First US, then Europe.
It was also interesting, Noor, to hear her actually talk about the transmission mechanism, right? Assuming that transmission remains strong. How's that worked? So we've seen actually quite a big laggard in terms of timing of, rates going up and actually how that slows down inflation.
Yeah, absolutely. And when you say that the ECB is data dependent, as they've been saying, it means that really exposes the market to a dovish surprise, because by virtue of the monetary transmission tool, you are expecting inflation to come down, to trickle down. Even that sticky inflation, services inflation print, that will eventually respond to those tools that, we only have those tools, right? I mean, monetary policy has its limitations. We can sit here and compare economics and, textbook theories on Taylor rule and what have you. But ultimately, what you've got here is an inflation print that is moderating, slowing, perhaps not as slow as we'd like it to be. The ECB's projections, even Lagarde has pointed to the fact that, they haven't, they've missed the ball quite a bit on that. And it has been tit for tat for quite some time. Wages and services remain key for the ECB going forward. But ultimately, as we see that inflation moderate, as we see the economy now potentially start responding to all that tightening, that quite aggressive tightening that we've seen, eventually the ECB will potentially react a lot more aggressively in a dovish manner than markets would be pricing it to. And that's where, that's where the ball game would hit. So while they say, we don't know anything beyond June, wages data in April, June, and into the summer can potentially really shift that tone quite aggressively, which is a concern for markets.
But I guess, is there too much of an optimistic bias in the markets? And we heard that, I think, yesterday from, the Vice President, Mr. de Guindos, saying, look, the market's view is very optimistic. And I think he also said, they're optimistic about a soft landing, that inflation will continue to fall. But he had a word of caution saying we could actually see a very different situation that leads to an abrupt adjustment.
Yeah.
So is there a concern that, inflation comes down and then actually shoots back up in the summer months?
Well, look, I mean, there's a lot less reliance, I think, or the measures that the ECB is looking at is trying not to account for all that commodity spike. And we have seen, if you look at the Bloomberg Commodities Index, the price index actually has come up, just recently in the past few sessions as well. So ultimately, there is this irrational exuberance that's taken markets by surprise, right? It's that AI-driven rally that's been feeding everything. But you have seen that take a breather now in the last sessions. Crypto stepped back. Even the tech stocks have kind of come down, and you've seen that rotation in stocks. So you've seen more bond proxies, utilities, real estate rise into that, the expectations that rates will eventually be cut down this year, and we're sort of front-loading that. So, yes, there's definitely going to be a lot of question about the current rally that we've seen, but right now there's very little that's stopping that. And what the Fed does today is really key for the next few months and how that market behavior is going to be.
Annika, what's your take on, first of all, the dot plot. Everyone's now watching the dot plot. So the Fed decides we're not expecting any policy change, but we're hoping to kind of read the tea leaves to what they do next. If you look at the Fed and the ECB, who's better at communicating what they're going to do to the markets? And is that a plus, or could it actually backfire?
Yeah, well, the dot plot's a really funny thing. So if you think about it practically, you've got 19 policy members at the Fed. They're all putting out their opinion, and their opinions are really fragmented. So if you see how many policymakers are putting out which dot, so essentially if two policymakers change their mind, the whole dot plot looks different. Then the market thinks, oh gosh, what are the tea leaves saying? And what I think is quite encouraging, because the market became far too obsessed with, did Powell sneeze harder today? Did Lagarde cough, harder? The market is now, I think, taking a step back and saying, okay, we do believe that the inflation path is looking more encouraging than a year ago. Rates are very likely to come down this year. By what speed? It is what it is. And you see that actually marginal changes in expectations in terms of when rates are coming down, that's not moving markets that much anymore. That's not causing equity markets to go all over the place, which is great news. It means that the markets are easier to navigate. And that's helped by the fact that companies and earnings and cash flows are strong. They're solid. So that's really helpful.
Annika, as always, thank you so much for joining us. Annika Treon there, the chief economist at Van Lanschot Kempen, as well, Bloomberg's Noor Al-Ali. Now, we need to also look at corporates, so certainly the Gucci warning is not to be missed. $7.6 billion have been wiped out from the market value of Kering after the company warned that sales at its key brand Gucci will plunge about 20% in the first quarter due to a steeper than expected decline in the Asia-Pacific region. Now, the French company has struggled to keep up with rivals like LVMH and Hermes as luxury sales have come off the boil over the past year, especially in China. You can see Kering down 14.3%. We also talked chips next, the boost for Intel as it wins almost $20 billion of incentives for U.S. chip plants. This is Bloomberg.
Changes in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
ECB President Christine Lagarde says the European Central Bank cannot commit to cuts beyond a likely first move in June. Intel wins almost $20 billion in grants and loans to help fund an expansion of its semiconductor factories. Plus, Kering shares tumble after it warns that Gucci sales will plunge in the first quarter on weakness in Asia. Other luxury stocks also sell off. Well, good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London. So Intel's been awarded almost $20 billion under the CHIPS and Science Act to expand its semiconductor factories in the U.S. It marks the largest award from a program designed to reinvigorate the domestic chip industry to cut Washington's reliance on technology made in Asia. Well, Bloomberg's Tom McKenzie is here. Tom, we're bringing out the big guns. This is a treat to have you talk about the chips. I mean, this is basically not really antagonizing China, but it's trying to just make the domestic chip sector a lot more viable.
Yeah, and it's about ensuring that the US is less vulnerable, less exposed, and is less reliant on those major chip providers in Asia, TSMC, for example, in Taiwan, but also Samsung in South Korea. So it's about building out that domestic industry. The CHIPS Act of 2022, really consequential, so setting aside grants and loans worth of $100 billion US, and now Intel taking the biggest slice so far in terms of those grants and loans. So about $8.5 billion US, $8.5 billion in grants and about $11 billion in loans. And Intel saying that this is really going to help. They're investing $100 billion US in the US market. They're building out factories and foundries in places like Ohio and Arizona. And so these grants and these loans from the Commerce Department will help in that investment push. Again, as Pat Gelsinger, the head of Intel, tries to build out this capacity in the US.
I mean, I guess the biggest fear is, you know, that then we're going to have too much. I mean, first of all, are they going to build the good semiconductors, right? The good chips, the good stuff.
Yeah.
And is there a worry that in 3-4 years, because of this overinvestment, that there's just too much of the stuff?
Well, you make really good points on both of those issues. One, yes, they're focused on the most cutting-edge semiconductors, so not the older legacy chips. They're really focused on the kind of chips, so 7 nanometers and below, 5 nanometers, 2 nanometers. In fact, Intel have taken delivery of ASML, the Dutch maker of these high-tech lithography machines. They've taken ownership of the most cutting-edge lithography machine from ASML, the first tech company, the first chip company to take in one of these machines. So yes, that's their focus on the really high-spec stuff. The other challenges are around ensuring that they have the talent, the workers, to be able to work in these foundries and factories. That's proven a challenge. Another frustration for a lot of these chip companies in the US is being able to get access to this funding more quickly, because the CHIPS Act has also been held up by some oversight into some of the environmental impacts. So there's a number of challenges. You're absolutely right, a lot of money flowing into this sector. Will there be overlaps? That is potentially another challenge down the line. Interestingly, Intel's key competitors, the likes of TSMC and Samsung, they are lined up to get funding as well to build out their factories and foundries in the US.
And then we also had the story about Huawei. So it's China actually possibly going after factories or links with Huawei. How antagonistic is that going to be?
Well, this is absolutely another piece of this puzzle. It's not a huge surprise that the US is considering further restrictions. What they're looking at when it comes to Huawei are some of these subsidiary companies or alleged subsidiary companies. So the allegations are Huawei has gone and funded and set up other companies under different names that don't face the existing restrictions. Huawei is already on the entity list, the blacklist. Now these other firms could be put on that list to make it more difficult for Huawei to achieve and get hold of US technology, but also technology from the Netherlands, Japan, and South Korea and Germany through these other routes, essentially. So they're the US trying to close the loopholes that they say Huawei have been able to build out. They haven't come to a firm decision yet. We don't know a time frame, but we know it's been actively considered.
Tom, thank you so much. A terrific briefing there from our Tom McKenzie. Now to some of the other tech stories in the headlines today. And Supermicro is understood to have cut its share sale price target to $875 each, with pricing set to be confirmed just before the shares begin trading later today. Now, the company had been offering to sell 2 million shares at between $900 and just over $1,000 each. The computer server maker has gained nearly 1,000% in the last year on the back of enthusiasm for AI. And Samsung shares had their biggest gain in more than 6 months after an endorsement by NVIDIA. Well, the chief executive Jensen Huang was reported as saying he's planning to use Samsung as a supplier of high-bandwidth memory chips. Now, NVIDIA unveiled its next generation of AI hardware called Blackwell at its conference in California this week. And Michael Dell unloading shares in his namesake computer company for the first time in almost 3 years, as Dell Technologies stock soars on artificial intelligence optimism. Now, Dell's chief executive has been selling on a near daily basis over the past 2 weeks and has now disposed of shares worth about $465 million. He still owns about half of the Texas-based company. Now, of course, it's Fed decision day, with the U.S. central bank poised to hold rates and likely avoid signaling any imminent reduction. That's as the FOMC focuses on stubborn inflation and a slowly rising jobless rate. Now, for more, let's get straight to Ven Ram from Bloomberg MLive. Ven, always good to speak to you. So which scenarios are trading looking to, and what is to be expected from the dot plot relative to the economy?
Morning, Francine. I think that, since the Fed last met, we have had major inputs into the financial system, obviously. One of them is, if you look at the financial conditions, what's happened to financial conditions? They have loosened, and loosened considerably, so much so that they are the loosest since 2021, i.e. before the Fed started raising rates in the cycle. So even if we haven't got de jure rate cuts, we have got de facto rate cuts that the markets have priced in. That is despite what has happened to treasuries in the past week. Now, if you look at inflation since the last dot plot, headline inflation is still bobbing around 3%. Core inflation is nudging almost 4%. And if you look at the labor market, employers continue to expand their payrolls at a pretty robust pace, as we heard in February. And if you look at wage inflation, that is still running above 4%. That is hardly consistent with an inflation target of 2%. So net-net, since the Fed previous dot plot, every input into the economy is saying that they should probably take back one of the 3 rate cuts they had penciled in, Francine.
But so what does this imply then for treasuries and other asset classes?
Well, I think, given the surge in 2-year yields that we saw in the past week, they rose 25 basis points, as you know, and that's a pretty humongous shift. Given that the front end is more or less come around to the idea that we'll get only 2 rate cuts this year, and so even if the Fed's dot plot acknowledges that today, I think that the reaction may be a bit mild, so there's not too much more of a sell-off to come on the front end. On the other hand, if the Fed sticks to 3 rate cuts, I think we'll see a bigger reaction and treasuries will rally and the dollar will be sold.
Yeah, and dollar is actually one of the big stories also, right? I think it rallied some 2% since the start of the year, whereas going into, certainly at the end of last year, this was, because of all the Fed cuts, people were expecting it to go the other way.
Yeah, absolutely. I mean, this is not the way the markets were expecting, whether it's on rates, it's on dollars, or on inflation. That's probably because, markets were too hasty in writing off inflation, and that hasn't happened at all, even in the Eurozone, even in the US, and to an even lesser extent in the UK. So far, the markets have got it completely wrong, or at least misread the tea leaves on the economy so far this year. We'll see what happens in the second half.
Ven, thank you so much. Ven ran there with the very latest, of course, on Treasuries, dollar, and the Fed. Now, some $7.6 billion has been wiped from the market value of Kering after the company warned that sales as its key brand Gucci will plunge about 20% in the first quarter due to a steeper than expected decline in the Asia-Pacific region. Now, the French company has struggled to keep up with rivals like LVMH and Hermes as luxury sales have come off the boil over the past year, especially in China. Now, if you look at luxury leading really a lot of the European stocks lower, again, because of this 20% reduction, there was a rebound after post-COVID. So if you look at China's lackluster post-COVID rebound, it's weighed on luxury, often considered Europe's version of high-growth tech, although the tech sector has rebounded after a dip in the second half of 2023. Now, European stock investors certainly had become more upbeat on economic growth and the earnings backdrop. Like cyclical sectors, for example, such as luxury and autos, are still affected by China's sluggish rebound. That sets up one of the key European growth sector for a disappointing first quarter reporting season, unless you have magnificent product that keeps on selling. I'm thinking of Hermes and LVMH that, for the moment, have defied expectations. Now, coming up, we also speak with the chief executive of Honeywell, Vimal Kapoor, on how the company is preparing for the future of automation, aviation, and green energy. That's next, and this is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups, is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Paul, I'm from the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blade, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
In our business in aerospace, we are nose to tail company, and we have multiple systems from cockpit controls to engines, APUs, environmental controls, satellite comms in a plane. And we typically go to an OEM like Boeing, Airbus, Bombardier, Embraer, and position our entire product line because we specialize in systems in a plane. So we get a lot of content, and in every plane you fly, we have a significant Honeywell content. So your question, our equipment is so critical, and because it's a system approach, we are not really one product which will backward integrable by anybody.
But how does aviation actually change from here? How much of it will be green? Right.
Electrification is the name of the game in future. I think in our lifespan, how much of will we fly in a plane with hydrogen cells, hydrogen fuel cells? I can't.
This is what, 10 years away, 15 years away?
I think technology is being developed, but what's available right here and now is use of sustainable aviation fuel. That's a technology which we provide through our energy transition part of our business, and our aerospace business tests that in our engines and our APUs, and that's something which is available today. You can blend all the way up to 50% of sustainable aviation fuel in the jet fuel, and that to me is available today. Where it will go forward is more electrification of different parts of the aeroplane. Think about cooling in the plane, think about propulsion in the plane, and that really positions the urban air mobility as the first platform which is be totally electrified. And that's what we're really working on in the future of aviation.
How would you describe U.S. manufacturing right now? Again, there have been problems with supply chains, which also mean that there's been a repatriation of supply chains. I don't know whether that's the end of multilateralism, but certainly it's given a massive boost to a lot of demand coming from the U.S.
Yeah, so U.S. supply chain, clearly there's more focus to have more indigenous supply chain in the U.S. for the last several years. Specifically in aerospace, there's a lot of rebuild of capacity. A lot of capacity was shed off in terms of during the COVID, and a lot of people went off work. And rebuilding the capacity with increased demand is an immediate challenge and opportunity for in aerospace, which we are working on. Yeah. But we also see in U.S. expansion of capacity in semiconductor fabs, in EV vehicle batteries, and others, industries of some nature. It will take a while for that capacity to set up. It's not going to happen overnight, but clearly we see the trend, and it helps us in our automation business because we automate a lot of these facilities in battery manufacturing, in gigafactories, and that's part of our growth vector.
And so automation or AI? Because AI could also help, for example, in supply chain, I guess, understanding what you need, where you need it, so that you preempt shortage.
We have been using that for probably 3 to 4 years, those techniques. But what excites me about AI is, in context of industrial world, this is one of the best tools to solve the skill issue. Right. Because skill shortage is a huge problem to all our industrial customers, whether it's people to how to operate the equipment, how to maintain it. And AI makes a average person more productive. The example, the thing in point is, I came to UK to live here in 2010. First couple of months, I used to use paper maps and always used to lose my way. Then came the Google Maps, and I never lost my way. So it was early version of AI where I was being assisted by somebody versus I was trying to be intelligent by myself. And I think in that same context, when you translate in industrial world, an operator or a maintenance technician, when assisted by a lot of our AI tools, makes them highly productive. So for our customers, it's a great opportunity to drive productivity and revenue growth, less about job displacement and other conversations.
But I was going to ask you about job displacement, because it must also actually mean that you lose jobs, and so part of that is retraining.
I look at it, there's always a productivity tool which comes in every few years. So this is the new productivity tool. Then skills migrate to a higher level. That's how I think about it. And when 4 or 5 years back, robotics process automation was a big deal in 2018, 2019. And that wave came in and it created certain process automation. Now it's AI. So I think the way I think about it is in context of an industrial company is that how do we use it to drive productivity? And then the next wave comes and we have to reskill ourselves to move on to the next level.
Well, that was Vimal Kapoor, the Honeywell chief executive, speaking to me earlier. Now, coming up, Reddit is set to price its shares today ahead of one of the year's most hotly anticipated IPOs. Well, after a long and unpredictable journey to market, we look to see how its fate could be in the hands of its users. That's next, and this is Bloomberg. You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession. And so there'll be difficulties, and we're working at. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
Bank of America Chief Executive there, Brian Moynihan, speaking exclusively to Bloomberg Surveillance. Now, the Brookfield Chief Executive, Bruce Flatt, says he sees opportunity in commercial real estate. The company is one of the world's largest real estate investors and has been exposed to the battered office property sector. Now, in a wide-ranging interview on Leaders with Lacroix, Bruce Flatt told me he believes fundamentals are improving.
Fundamentals are pretty good in a lot of commercial real estate. Of course, there's a tail of some investors that had properties that for this environment, the fundamentals either don't support it or the financing they have can't be supported, and therefore those have to get dealt with. So that's a tail that's getting dealt with within the financial system. Fundamentals are actually getting better. Interest rates are coming down, which means the values are going to improve. But that tail, there's opportunity coming. And if you know what you're doing, you can pick the right assets. There's a great opportunity here. And we've done this for a long period of time, and we've seen these cycles before. Real estate's cyclical, and you can make a lot of money when you pick the inflection point of markets. And I remember it in the early 90s. I remembered it in early 2000s. I remembered it in 2009, 10, 11, 12. There are points when there's an inflection point, and we're at one of those inflection points.
Well, you can see the full interview on Leaders with Lacroix tonight at 9:30 p.m. in New York, and again on Thursday, 6:30 p.m. in London. Now, the social media platform Reddit is set to price its shares today ahead of one of the year's most hotly anticipated IPOs slated for tomorrow. Well, here to discuss all of this is Bloomberg's Charlie Wells. He's been speaking with users of the platform ahead of the share sale. I mean, it's so exciting, Charlie. Welcome to the Pulse. So one widely discussed feature is the fact that the IPO, 8% of shares have been set aside for these Reddit super users. So you've been speaking to them. What are they saying?
Yeah, so I've been down in Wall Street Bets talking to people who go on these forums, talk about stocks, talk about selling, and then now they're talking about Reddit. And it's hotly debated. I think Reddit, everyone's always got kind of a hot take. I've been talking to some of these super users who are invited to take part in this access to these shares. They're offended. They say this is sort of like management coming to a union meeting and offering management jobs to people. Others are really excited, though. They see this as a potential opportunity to make a lot of money off a pop if that share price pops tomorrow.
So, I mean, I guess the Reddit's IPO and the retail interest in it, is it a sign of resurgence in IPOs in general? It's very specific to Reddit.
I mean, look, I think that's what the market hopes. And Reddit has had this kind of long and winding road to an IPO. They confidentially filed in 2021. Well, we know 2021 was a bumper year. The U.S. IPO market hit a record $339 billion. Last year, it wasn't so great. It was $26 billion. So, there was a lot of hope last autumn with ARM. There was hope with Instacart. But look, Reddit, it depends on how they do tomorrow, but there's a lot of companies waiting to see, how they price and how they perform.
So Charlie, how unusual is it actually to offer, some shares to special users?
It's pretty unusual. These are called affinity programs, and it kind of goes back. I love kind of 90s nostalgia. And actually, one of the first real famous examples in the United States was in 1995 when the Boston Beer Company offered people who liked its six-packs coupons in those six-packs that they could then mail back with checks to buy shares. We saw Airbnb do this. They invited hosts to take part. We saw Deliveroo do that here in the UK. It can work really well, but it can also fail if the share price doesn't perform.
Yeah, I think Soho House maybe also tried the same at the margin. Charlie Wells, as always, thank you so much for joining us. Now, a reminder that later today, Bloomberg also has an exclusive interview with Ukraine's Prime Minister, Denis Shmyhal. You can catch that from 12:45 UK time. Surveillance up ahead. This is Bloomberg.
me ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Fed has latitude that a lot of places don't have, that they can be hold a restrictive and let the economy really catch up.
If financial conditions are easier, then there's less easing for the Fed to do.
They're telling you we want to cut rates. The problem is the data is not letting.
There's no doubt that financial conditions have eased rather dramatically in the course of the past few months.
I think they should, as a matter of long-term strategic policy, move back to a neutral rate because the economy doesn't need them to be tight.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
4 months ago, March 20th was a big deal. This was going to be the day the Federal Reserve was going to reduce interest rates, and here we are, still trying to work out when that's going to happen. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Equity futures a little bit softer on the S&P, coming off a two-day winning streak on the S&P 500. Lisa, the data disrupting the storytelling of the end of last year.
Which is really what I've read from pretty much every analyst and had in conversations. This is going to be a difficult Fed meeting, and the question is, do they publicly question their assumption of 3 rate cuts at this meeting, and do they publicly allow that maybe rates aren't going to fall as much as they thought in the next couple of years?
So I always say 3-part story, got to work through a statement, a news conference. In between, I'm going straight to the projections. I'm sure you are as well. Trying to work out whether those two policymakers, because that's all it's going to take, just 2 dots to come up to make the median dot 2 cuts and not 3. And then if that happens, it's up to Chairman Powell in the news conference to kind of shape the agenda, the narrative for financial markets.
So they're the 2 dots versus the 3 dots. Very exciting dot party. Everyone's extremely excited to talk about dots all day long. We will be doing that. Join us for our special. But I am curious also about beyond that, beyond 2024. What about 2025, 2026? If they start to pull back how far rates can go, how much they can come down, that's going to be a revamp of what we saw in December. That's basically saying our expectations for getting to neutral pretty quickly, I don't know, perhaps a little premature.
I've asked the same question for about a month. Has Chairman Powell gained confidence, lost confidence, or retained confidence since the news conference at the end of January? Based on the data we've had, wouldn't you suggest that he should be losing a little bit of confidence right now? Now, whether he shares that publicly is another story altogether, but ultimately based on the information, I wouldn't be looking at that and gaining confidence from what I've seen so far.
The market's not gaining confidence. In fact, the market's pushing back rate cuts pretty significantly, and there are an increasing number of analysts saying, wait a second, maybe neutral is 3.5%, maybe it's even 4%. Is the Fed going to address this? Who knows? My guess is it really depends on financial conditions and how worried they are about a stock market that's at record highs, a bond market that's held in even as benchmark rates climb, if they're worried about that or not. To me, the financial conditions question might be the most crucial one to understand their psychology and just how much they think the market's getting away from what they're trying to do.
It's amazing how this is set up. All-time highs on the S&P 500 going into a Fed decision where there is still an obsession about them reducing interest rates. Equity futures right now on the S&P negative by 0.1%. This is what we look like on the S&P and in the bond market as well. In the bond market on a 10-year Treasury at the moment, yields lower by a single basis point, 4.27. Let's call it 4.28. Out of the 4.30s in the last 24 hours, yields dropping away just a touch. In the FX market, dollar absolutely dominant in G10 over the last week, 108.38. And if I can turn briefly to dollar yen, the fact of the matter is this yen is not strengthening, it is weakening. Dollar yen is through 151. Lisa, for a sixth consecutive session, we've had some Japanese yen weakness. We're about to make it day 7.
And we're about to touch the weakest level going back to 1990 versus the dollar. Against the euro, it's at a 16-year low of 164.60. I'm looking at these numbers and trying to figure out, was this what the Bank of Japan wanted? Or does this basically force their hand yet again and say, is this really necessary for you to have such a dovish tone while making a sort of very incremental rate hike to 0? This, to me, is going to be a challenge for them because it imports the wrong kind of inflation.
151.68 on dollar yen. Coming up this hour, lots to discuss. George Concavas of MUFG expecting a dovish Fed ahead of today's rate decision. Ed Mills of Raymond James on the challenges facing mergers and acquisitions in Washington. And Francis Donald of Manulife seeing growing signs of weakness in the U.S. labor market. We begin with our top story, counting you down to the Fed decision at 2 p.m. Eastern Time. George Concavas of MUFG suggesting it should act before it's too late. We believe the internals of the labor market are not as strong as headlines suggest. The Fed should see through the sticky inflation data and proactively cut before actually seeing a rise in the unemployment rate. George is with us around the table. George, it is fantastic to see you, sir. Let's set things up as follows.
Great to be here.
The difference between what you think they should do and what they will do. We can start with should. Why do you think they should be reducing interest rates right now?
Look, it's always about getting ahead of what lies down the road. And the question is, they have a dual mandate. And it's always been the most challenging thing for the Fed, balancing between full employment and getting inflation under control, which has been their primary focus for the last 2 years. But my concern, our concern in general, is that the longer they wait to at least kind of slowly get us into normalizing rates and then see how the economy is handling it, and we also got fiscal policy behind us, that if they wait too long, they run the risk of a deceleration that really becomes more protracted in the second half.
Let's go back to that quote. You say they should look through the sticky inflation, the hotter than expected reads of the last month or so. Why should they do that?
Because look, the classic thing that we're all concerned about is the wage price spiral, right? And that's been the case all along. We are concerned that these kind of higher wages or the tightness in the labor market would result in higher inflation. And in fact, a lot of this was supply chain disruptions, energy, and things like that. And so if you are waiting on the wages side, there are signs in the labor market that things are decelerating and wages are also coming down. So like you run this risk that if you wait too long, then you actually start to hurt the jobs market.
Okay, this is the tricky part, and honestly, I spent a lot of time thinking about this. We've been waiting for the slowdown. We've been seeing signs of weakness for a full year now, if not more. People have been waiting for this, and I'm looking right now at the Atlanta wage tracker, Atlanta Fed wage tracker. It's coming in at about 5%. It's still well above where neutral would suggest. What are you pointing to that gives you conviction that this time is different and that weakness is actually more imminent than, say, 3 years out, 4 years out, when we can see more of an entrenchment of inflation?
Well, I mean, a lot of leading indicators, like for example, like the quits rates will lead that wage index. So about 6 months down the road, that wage index can be 3.5 very easily. And then the question, that's still a healthy number, but it's the pace and the deceleration there. And it's it's a composition of the jobs that we're creating, the part-time versus full-time. And there's been a stalling out of professional services. This has been primarily travel, leisure, hospitality, lower-paying type jobs. And if we don't if those start to kind of lose pricing power as well, they're the easiest ones to get laid off. And that's the concern. My concern is we're hiring at a very fast pace, but if we miscalculate the landing, those jobs could be gone in a heartbeat.
Why is the balance of risks more important for you to focus on potential weakness in the labor market versus persistent inflation that doesn't seem to be going away?
Because it's a balancing act. That's the whole point of balance of risk. That if you don't get it right, you miscalculate on what happens on the back end of it, and it's going to come down to a judgment call. And this is why John brings up the great point. It's not what they should do; it's what they will do. And because they got inflation wrong for so long, and they were stuck with transitory inflation, and that was the narrative, they're probably going to overstay their welcome in our view, and that's going to cause problems later on.
So should and what you believe. I think what you believe right now from listening to you is that the later they start, the more they're going to have to do further down the road. Listening to the concerns that other people have, and the question that Lisa raises is ultimately the earlier they go, the more likely inflation returns. Which risk do you think wins out on the FOMC at today's meeting and ultimately over the next several months as well?
But here's the thing, though. Does the Fed actually generate inflation? I mean, that's a philosophical question that we have to ask.
Do you think they believe they do?
I think they believe that they influence financial conditions and that they have a strong effect on interest rates, of course. So the question is more about the FCI channel. How quick is it to actually translate into inflation? Because if we start off with concerns around wages, the jobs market is weakening, that's in the background. If you then shift towards FCI, could be fleeting. Markets are at the highs as of yesterday, but are they at the highs 3-6 months down the road? And then that will be disinflationary.
Well, but this really goes to the question of if financial conditions is the transmission mechanism of the Federal Reserve, shouldn't it worry them that their transmission mechanism is malfunctioning if the goal is to bring down inflation?
It's been delayed, and it's been delayed because last year, and still lingering this year, fiscal policy has probably offset 150 to 200 bips of the Fed's actual tightening. That's a pretty powerful move. If you translate the actual quantum of how much government spending we've had in the various government jobs, which also kind of has kept the jobs market stronger than what it seems on the private side, if it wasn't for all of that fiscal, then Fed policy would be much more effective.
Which is the reason why it really shocks me when we get person after person coming on and saying that fiscal is still coming. This morning, we get news of some $20 billion going to an Intel factory. There is so much money still getting poured into the industrial sectors that a lot of people, particularly equity strategists, come on and they say, this is why we're bullish. We see the money and it is still coming. We look at the savings accounts. They are still flush with cash from consumers who are making money. How do you dismiss the fiscal impulse as something that's fleeting when it doesn't seem like it's so fleeting? And frankly, the Fed can't offset that.
Look, it's bifurcated. It's bifurcated within the stock market. You have a very narrow set that's benefiting from this. And it's bifurcated across the U.S. households. The top 20% are basically holding half of the economy up. And so that can work up until it doesn't. I think that's the part. This is like such a sensitive, and we're so at the mercy of financial conditions and like what our valuations are. We price to perfection and has a lot of this sort of belief that this money will keep coming in. What if it slows down? I'm a big believer of rate of change, and even though it keeps kind of trickling out, I doubt we beat that bogey from last year. So I think from this point forward, it becomes much more of a level playing field on fundamentals between Fed policy versus fiscal policy, and what is the true state of the economy.
We've got to get some yield forecasts from you before you go as well. Can we talk about that? 470 at the front end, there and thereabouts, 430 on a 10-year, and how the Bank of Japan would influence your thinking at the moment. I can see that's exciting you. Yeah. What's going on at the BOJ, and why isn't it shaking up markets in a bigger way?
Well, I mean, look, a super well televised, ending up with a dovish hike with a lot of concern that this would be the start of repatriation of money back to Japan, that there was going to be a lack of sponsorship for the U.S. fixed income market. We take the other side, which is that this is, again, because it was so well televised, and the Japanese have been very defensive for the last 18 months during the hiking cycle, that in reality, this is not that consequential of a move. Now, it is kind of a little bit like chicken and egg, where BOJ almost like needs the Fed to ease now or ease soon, because they'll do a lot of the work for them. But if not, then you have a risk that this 150 numbers is a big deal on the dollar-yen, and if it keeps going, that's why treasuries are rallying. People are realizing that there's going to be a need for U.S. fixed income in Japan.
So your bias is lower yields?
Look, my bias is that market is sometimes too smart for its own good, and we priced in a rate cutting cycle multiple times now, and the Fed has yet to deliver. So it could become, it might end up being very anticlimactic and very similar to the BOJ. The Fed eases, and we're like, oh, it's already priced in. Bonds don't move.
Got it. George, it's good to see you. Really thoughtful. I can't believe it's actually been about 5 years since George has sat around a table with us, which is unbelievable.
And it's wonderful to have him, I've got to say. I love the way that you kind of think through things. And honestly, this is the debate that's underpinning so much of the disagreement on Wall Street right now. And this is the reason why it's so polarized.
I also can't believe that dollar yen is pushing 152, 151.70-ish. George, it's good to see you. Thank you, sir. George Concalves there of MUFG. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. Inflation in the UK falling more sharply than expected, cooling to the lowest level in 2.5 years. The Consumer Prices Index rose 3.4% in February from a year earlier. That's slower than the 4% pace the month before. Economists say the data keeps the Bank of England on track to reduce interest rates later this year. The Texas migrant arrest law is back on hold. Just hours after the law briefly took effect, a federal appeals court stepped in, preventing Texas from arresting and deporting migrants accused of entering the U.S. illegally. A 3-judge panel intervened after a series of back-and-forth court orders that even saw the Supreme Court weigh in. That 3-judge panel meets today. Primary elections were held in Arizona, Florida, Illinois, Kansas, and Ohio yesterday. Former President Donald Trump won all 5 Republican primaries with 75 to 81% support. Meanwhile, President Biden won 4 Democratic primaries after Florida canceled his vote. He received 83 to 91% of the vote. Kansas was the only state with an option for voters to choose none of the above on the Democratic ballot. It took 10%, John. That's your Bloomberg Brief.
Yahara, thank you. Appreciate it. Up next on the program, M&A roadblocks in Washington.
Not everybody has a staying power to fight through, lawsuits, time and effort and things like that. At the end of the day, consolidation comes because of strategic import, and I think you have to let capitalism run.
That conversation up next, live from New York City this morning. Good morning.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Today, the Fed decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data. We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
It is Fed decision day. Equity futures on the S&P 500, just about negative by almost 0.1%. No drama there. All-time highs at a close yesterday. Going into this decision a little bit later on this afternoon. Yields a little bit lower. We're down a basis point on a 10-year, 427.68. Under surveillance this morning, M&A roadblocks in Washington.
we need to get this resolved. We need to get a more rational, predictive outcome to have people willing to take the risk of putting their company at risk for a sell side, and that's really what it comes down to. Not everybody has the staying power to fight through lawsuits, time and effort and things like that. At the end of the day, consolidation comes because of strategic import, and I think you have to let capitalism run.
Here's the latest this morning. A number of deals facing pressure in Washington, including tie-ups between Kroger and Albertsons, Capital One and Discover, and U.S. Steel and Nippon. Ed Mills of Raymond James saying, quote, "It should come as no surprise that the Biden administration is putting up roadblocks to M&A. Under a potential Trump presidency, we're likely to see a shift in focus, but the populist politics that have been driving the antitrust DC policies is bipartisan." Ed Mills is with us in the studio here in New York. Ed, I'm so pleased you've made this point because I think it's really important. Just how much distance is there between the two parties right now on this issue?
Well, when we look back to look at Lena Khan, when she was confirmed by the Senate, it was overwhelmingly bipartisan. And she's the head of the FTC, the big antitrust regulator in D.C. The only thing that Republicans didn't like is that she was put in charge as chair. When we look at Donald Trump, he ran as a populist. We have large antitrust activity in this country when we have major technological change, major income inequality, and when there's populist politics. That's not going to change with this election. The focus will shift. It might become more transactional, more kind of specific to kind of what maybe a Donald Trump likes or dislikes, but it's not an all clear after the election if Donald Trump is elected.
The language both sides use is different, but ultimately the state is getting bigger and not smaller. Is anyone arguing for small government in Washington, D.C. anymore?
No. I think what we are looking at is kind of where, when you are in charge, you want to push your priorities. And so what we've said on antitrust as well is that we've had a seismic shift at a glacial pace. And what we're seeing with a lot of these deals is that the approval process is part of that glacial pace, because getting anything done and getting folks to the table being willing to put their companies at risk for that approval process is getting harder and harder.
Not to get too philosophical, but what's the new form of American capitalism at a time where you've got antitrust issues getting enforced, deals that aren't getting through, and then you're getting tons of money being poured into the new national champions, whether it's electric vehicle policies or whether it's some of these loans and other grants to the likes of Intel because of some of the concerns around security?
Yeah, Lisa, what we said is that the new kind of change in policy is that technology is a national security asset. So we should look at some of the government funding for technology similar to a defense budget. We are trying to rebuild our industrial base in the United States. That was what was behind the Inflation Reduction Act. That was behind the Chips and Science Act. That was behind the bipartisan infrastructure bill. And so the dollar amount that governments are willing to put into different sectors and into different companies is all national security driven. Even on electric vehicles, we have fought wars for a generation in the Middle East over access to oil. A lot of policymakers in D.C. say, if we shift to an electric economy, we need to make sure that electric components in the EV batteries are made here in the United States versus in a geopolitically vulnerable space. The fact that Taiwan has the leading semiconductors, that's a very geographically and geopolitically vulnerable space. So investing in that is an investment in the defense budget and rebuilds the industrial base of the United States.
George Goncalves of MUFG was just on, and he was saying that he expects fiscal spending to stop. With central planning that's trying to pick national winners, how can fiscal spending stop? Doesn't it have to continue to support some of these industries?
Yeah, I'd be on the side of the disagreement. When we started this Congress after Republicans won a majority in the House of Representatives, everyone thought we'd get cuts. We are on the verge of finally passing kind of the appropriations bills for this year. We're going to have flat for domestic, 3% up on defense. We still could do a defense supplemental. We have all of those bills that I've talked about just hitting the economy. And on the Chips and Science Act, we got awards for Intel. That's not exactly what they want. They want more. And so you're going to have a push for a CHIPS Act 2.0. The spigot is on in D.C., and that's supporting the economy, and I think is very much supporting a soft landing or no landing from an economics perspective.
It's amazing some of the numbers involved. Ed, can we talk about how we got here, what this is in response to? And some people might argue that maybe it was in response to China and Made in China 2025 over the last decade, which was pretty bold and I would say even brazen, coming out and just saying, these are the industries we're going to dominate. And as some commentators have talked about recently, they might have stopped talking about Made in China 2025, but they carried on executing the plan. I've always looked at this situation and reflected on how we used to look at things 10, 20 years ago, where people in the West, and I've said arrogantly and mistakenly, believed that China would become more like us in the West. And it sounds like, listening to you, that we're becoming more like China. And it's going to look more and more like China in the years to come. Now, I'm not saying that Washington, D.C. is turning into the CCP. Some of you might think they are.
I think
I'm not saying that this morning. I'm not saying that. But I am saying we're going down a path that we didn't think we'd be going down, are we?
Well, I think it's more eyes wide open as it relates to China. I always talk about the fact that for years, one of the conversations in D.C. was that you had to treat China in a certain way, that if you cause embarrassment, if they lost face, that was the worst case scenario. And now we have policy that, essentially punches them in the face, and they're still talking to us. So the conversation in D.C. has changed, and that posture towards D.C. is, the posture towards China has changed. You talk about China 2025. What folks in the Defense Department and people that I talked to were focused on was, China 2027, which is when they want to have the military capability of an attack on Taiwan if they wanted to. And all of these tech restrictions, we're trying to push back that timeline, not giving them the semiconductors, not giving them the artificial intelligence that is necessary to, pull off that attack if they wanted to do that. We don't think that they are near that, but it is all about national security. What are the areas that we still control as the United States government and as our technological leadership here in the United States, and what can we do to slow down China in what they want to do?
To John's point, though, is fighting China becoming China? Is that essentially what we're seeing with some of the more focus on national champions and central planning?
So I think we do it very differently. We don't have state-owned enterprises. There's still a huge focus in Washington, D.C., and part of the delay between the passage of the CHIPS Act and the passage of the IRA in getting this money out is making sure that there's some level of support for what's being done. They are prioritizing projects that actually can happen. Back in the Obama administration, when there was the stimulus bill that subsidized solar, and there was a lot of blowups there, that has changed the policy. We'll see if it's right this time, but there's at least a focus on what are the projects that actually can get done and actually be successful. Hit project goals by 2030 is a key component of what the Commerce Department is doing. So they get blamed for taking longer, but hopefully they're doing it right.
I'm thinking of one industry where the market is pushing back against the state quite aggressively, and that seems to be the auto industry right now. How do you see that turning out in the next couple of years? EVs just aren't taking off in the way this administration would like them to. What can they do about that?
So I think what we're focused on with the auto industry is kind of the fact that Michigan is one of the key states. Whoever wins Michigan probably is president. And so you had an unprecedented act by President Biden showing up on a picket line for the auto workers. I think that the next thing that we're going to see is an aggressive fight against Chinese-made cars and where they're going in the world. That's the next trade fight that is coming here. We're going to see a focus not on EVs necessarily from China, but there's a lot of excess capacity that is in China on internal combustion engines, the ICE vehicles. Where they are going, are they going to flood the market? Is that going to be a challenge to Detroit? That's what you're going to see in D.C. As a huge fight for the industry.
Fascinating. That fight picked up big time over the weekend with threats of 100% tariffs on Chinese EVs made in Mexico. And it's great to see you. Want to do this again?
The way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values. Personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called a culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits That's like, again, like a super organism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Hi, everyone, and welcome to this webinar on the Microsoft Power Platform. How does AI and low-code help you as an organization accelerate your innovation? It's a topic that is, it's hot. I would say it's a buzzword that we hear all over. And so, especially for today, we've got a team of people that will talk a little bit about that. First of all, we will have IDC and Harish, who is located in Dubai. He will talk about what IDC sees and the trends that IDC picks up at the customers, their customers, our customers, you. And then after hearing from Harish, we will talk together with Zoe, who is a Power Platform specialist out of the Netherlands. And we will share some experiences and some insights on what we see that is happening on the Power Platform within our customer base across the world. And then at the end, we'll also have some really cool demos on what the platform can do for you and how you can start to build, hopefully today. So without any hesitation or ado, I want to pass the word to Harish in Dubai. Harish, welcome, and looking forward to hearing the point of view from IDC.
Thank you, Harold, and thank you, Microsoft, for inviting IDC to speak at this event. Harold briefly introduced me. My name is Harish Dunake. I'm a Senior Research Director at IDC for Software and Cloud Program. And I'm going to share a few interesting trends and insights about how organizations can accelerate innovation by using new age software development technologies. So let me take you through the agenda of my session. Any conversation about driving innovation is incomplete without agility. And agility is greatly enabled by cloud these days. I'll briefly mention the role of cloud in delivering innovation agendas of the organizations. I'll also briefly touch upon how a culture of innovation is key for sustainable growth. Large language models are disrupting the way we live our lives, but at the same time, they are empowering innovation. I'll talk about that. And finally, I'll conclude my presentation with a few recommendations to you. One of the major benefits of cloud is operational excellence. Whether it's cloud-based software or application development platforms, infrastructure are helping organizations adopt intelligent automation to reduce wasteful, mundane, and sometimes boring and repetitive tasks. This also means they can repurpose their people to more meaningful and more value-adding activities. Cloud, to some extent, is helping them reduce cost and gain supply chain visibility. Now, when it comes to employee productivity and their experience, almost half of the respondents of IDC's survey acknowledge that cloud helps them in enhancing employee experience and in retaining new talent. New business model, and this one is my favorite, by the way. Cloud is helping a lot of organizations monetize their investments in technology, data monetization, API monetization. Secondly, it also helping organizations open new revenue channels through marketplaces and other digital channels through which they can create completely new revenue streams. Apart from these, cloud adoption is assisting organizations in data security and compliance to various regulations. I'll come to agility in a few seconds. However, cloud is also helping our leaders to create sustainable business practices and reduce scope 1 and 2 emissions. Now, let me double click on agility here. Cloud is helping organizations create an agile culture where companies can fast track, accelerate their time to market, fast track time to value by accelerating product delivery. The technology that stays backstage, in fact, especially transaction systems, systems of record such as ERP, CRM, supply chain management system, billing system, inventory management system, and various such systems can be delivered and deployed rapidly with the help of cloud-based development platforms. Let's look at the slide now, the next slide, which is about sustainable growth, which is at the center for most of the innovation agendas of organizations worldwide. IDC's research reveals that agility, which is enabled by rapid application delivery, is an imperative for digital innovation. We know that companies want to release products faster than their competitors. They want to attract the best of the talent available in the market before that talent decides to do something else with their lives. Companies want to attract and retain customers, which now includes Gen Z and millennia, which are more likely to churn if they receive better experiences, better prices somewhere else. The trends that you can see on the slide can help organizations achieve agility and create an organization that can deliver sustainable growth even during uncertain times. The rise of low-code and no-code is helping organizations cascade software delivery timelines and reduce costs significantly. The involvement of business users in software development lifecycle is making DevSecOps as BizDevSecOps. This is an interesting trend. Now, this is bringing business teams early in the loop, is great, and it is greatly saving time during development, testing, and operations. In use of natural language, IDC predicts that by 2028, natural language will become the most widely used programming language, with developers using it to create 55%, I repeat, 55% of net new applications. I spoke about cloud earlier. Of course, there are certain functionalities exclusively available on cloud, and vendors are releasing these new tools, features, development platforms on cloud. Adoption of these cloud-based development platforms can accelerate rapid application delivery. Digital innovation is also helping organizations earn more money. IDC's research further reveals that by 2026, enterprises that successfully generate digital innovation will derive almost or more than 25% of revenue from digital products, services, and or experiences, and also talent gap. Talent gap, or at IDC we call it talent mismatch, is a global problem. Most companies have people with older skills and lack people with low code, no code, AI, Gen AI, and these companies can include line of business users in these tech jobs, which essentially adds new skills to the lines of businesses and help management bridge the talent gap to a certain extent, if not 100%. Now, on this particular slide, you can see how the recent survey of senior business executives reveals very interesting trends. So when we ask these senior leaders about their priorities, quite obviously, skill development tops the chart. However, what is surprising is these executives realize the importance of a culture that needs to promote innovation. Because the culture of innovation is a key for sustainable growth, whether for commercial organizations or for non-profit organizations. We know that the culture of innovation relies heavily on visionary leadership, bright ideas, effective change management, new age skills, and path-breaking technologies. But then we are discussing the role of technology in innovation today. So let's talk about technology. And I briefly spoke about cloud and intelligent automation earlier. Now let me take you to the next slide, which talks about, or which highlights the artificial intelligence and generative AI and how it can help organizations innovate faster. AI and Gen AI enabled coding assistants, and you can see that on the left side. AI and Gen AI enabled coding assistants are getting embedded into the software development. These digital programmers, these digital workers have the potential to help programmers and developers develop software faster. The app dev tools, code libraries, code repositories are further accelerating the process of software development. Now, when it comes to software delivery, by 2028, GenAI-based tools will be capable of writing 80%, I repeat, 80% of software tests, decreasing the need for manual testing and resulting in improvements to test coverage, test software usability, and code quality. Now, this is huge. Code-specific foundation models and tools to generate images and also to design user interfaces are further going to accelerate the full stack of the software development. This means our developers will have more time. This means they will be able to use this time to do some more value-adding, more insightful, more meaningful, and more useful work. As you can see on the screen, by 2028, new efficiencies will allow developers to increase the share of their time that they spend on innovation, which is 25% now, to a whopping 75% of their development-related work. Now, this is again huge. And ladies and gentlemen, this is my final slide. I hope you have enjoyed the insights I have shared so far. I believe digital innovation is a collective responsibility. Line of business users and IT teams need to collaborate with a unified goal of creating an agile organization, a resilient organization that can withstand macroeconomic calamities, macroeconomic situations, not only survive, but also thrive in challenging times. For that, we need to adapt, and we need to adopt intelligent automation. We need to adopt artificial intelligence. We need to adopt generative AI, low code, and with cloud being its foundational platform. And organizations need to adopt these technologies faster. Finally, digital innovation is not an end goal, rather it is a strategic intent. Sometimes pursuing innovation for the sake of innovation is needed. The pace of change of technology is rapid. We experienced industrial automation in the past. Now we are experiencing AI-enabled intelligent automation. We never know what will come our way 10 years or even 5 years from now. Therefore, pursuit of innovation should be the way of life. And thank you. I hope you found my presentation and insights useful. Harold, back to you in Amsterdam. Thanks a lot.
Harish, what an amazing story. I mean, it's so inspiring to see that our customers are telling you the same as they're telling us. But I do have a few questions, if I may. And so the first question that I noticed was that you had the term developer a few times on your slides. And I wanted to ask you, what do you mean with the term developer? As I think it might have changed over the last couple.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Couple of years. So kind of would love to get your insight on that one.
Perhaps the definition of a developer has shifted in recent times. With technologies such as low code, no code, people with absolutely no software background or training on software development can contribute to the software development process. They just need to know the business requirements. It seems like everyone is a developer in some way or the other. So I would say it is anyone who creates a solution for their business needs, both people in IT as well as line of business users. In the best case, they even build solutions together. I hope this answers your question, Harold.
Cool. So a second question I have was, you mentioned large language models at a certain point and natural language. So could you elaborate a little bit more on the importance of data and AI in this new way or this new era of application development? Because I think it will have quite a bit of an impact.
Absolutely. I can see there are 2 parts to your questions. First is about the natural language, and the second is about the importance of data and AI. So let me talk about data and AI first to start with. So it's not just about an application, a software application, but also about the data that drives its functionality. You won't believe, but interestingly, our research indicates that 72% of the organizations lack clarity on who has accessed or manipulated or modified the data before the data has reached the data user. We need to ensure we have clean data, we have complete data, we have comprehensive data and recent data to realize the value of any AI-led digital initiative. I've spoken about cloud earlier, and I should mention here that AI adoption that we see today is largely enabled by cloud. Cloud-based tools, cloud-based technologies, and functionalities make it a lot easier to drive innovation as long as we have accurate, recent, and complete data. Now, going back to your question about natural language. Regarding natural language, with the large language models and AI, we see that the software development is no longer coding. Gen AI has really decoded software development and democratized it to a great extent. And we can talk and develop software now. Speech-to-text capabilities or text-to-code capabilities have revolutionized the way people used to develop software. And remember, software development is at the center of any digital innovation initiative.
So, and maybe if we have some time, Harish, one final question. On your first slide, or one of your first slides, you had, operational excellence, productivity, cost savings. It is something that I often hear from our customers, and we often kind of position this as part of the hyper-automation efforts that organizations are going through. Is that something you, as IDC, see as well? Is that a trend that you pick up today?
Of course, at IDC, we refer to this as intelligent automation. So let's delve deeper into this concept. Intelligent automation allows organizations to give a hard look at the unwanted fat or any inefficiencies that they're causing, duplication, delays, and it proactively helps process owners with process transformation recommendations. Whether it is an insurance claim process or a customer onboarding process, or in case of a bank, or in case of a telecom service provider, or a supplier registration process for a retailer. Exposing inefficiencies and optimizing them proactively by using predictions that are enabled by artificial intelligence can greatly simplify our lives. In the case of the insurance industry, our latest study reveals that 48%, this is a huge number, 48% insurance organizations across Europe, Middle East, and Africa say that improving customer experience is the top reason for them to invest in AI-enabled intelligent automation, which we call as intelligent automation. And of course, there is a correlation between improved customer experience and customer churn, improved customer experience and revenue, improved customer experience and profitability. Thank you. Over to you, Harold, there in Amsterdam. Thank you.
Thank you very much, Harish, for all the insights. It's great to see the thinking of IDC, because you usually are kind of a step ahead and you see what our customers are looking for. And I'm thrilled because it fits perfectly with what we're trying to do at Microsoft with our Power Platform. And so, like I said in the beginning, together with Zoe, we will jump into what the Power Platform can mean to you. It's really there to inspire you, and feel free to use the chat if you have any questions. So let's begin. And I want to begin with a small video that's running, right? And there's a reason why I'm showing this video. And when this video is done, I actually have another video, And the other video is completely different than that first one, but yet they have something in common. And I wish we were here in person, because then I could ask you, but the fun thing is about both of these videos is that they are AI generated. So some of you know GPT, great, you can ask a question, you get an answer. Some of you know DALL-E, great, you can prompt and you can get an image. But actually last week a new service was released, or actually announced, where you can prompt and create videos. And this is mind-blowing, right? Imagine a year ago when you wanted to create a video, you needed a drone, you needed a camera, you needed somebody who can edit it. Now you just say words and AI will generate it. And why am I saying this? And actually, it's because of the next part. Because I travel quite a bit for my work, and what you see on the screen is what we call a matrix printer. And it's, I don't know how old it is, but I think it's at least 30 years old. And the fun part about this matrix printer was that it's actually the core component of a process that allows 300 plus people to board a plane. So on one hand, we're building images and videos with AI based on prompting, like we just type in some words. But at the same time, we're actually waiting for a matrix printer, like the lady standing next to it. We're waiting on a matrix printer to stop printing to board hundreds of people onto one of the most advanced kind of transportation vehicles in the world. And this is crazy. And this is why we're here today. And so with the coming of AI, with everything that is coming, not just GPT, we're way advanced already. There's a momentum for everyone, for every organization to really kind of rethink, retool every business process. because a lot of what you've done in the past is great, but imagine what you can do with all the things that is coming because of AI. And so to start our journey today, I want to start with kind of a customer, and a customer that some of you might know, but it's Rabobank. And Rabobank is a Dutch bank. And when they first came to us, they were not looking for an app, they were not looking for a chatbot, they were not looking for any technology. They were looking for 1 million hours. I mean, let that sink in. 1 million hours. There is no application anywhere that can give you 1 million hours. And so what they understood is that if we want to have 1 million hours back because we don't have enough people, we want to save costs, we want to kind of free up time from the people that we have, they were looking for a platform. And that's exactly what we're trying to provide to them with the Microsoft Power Platform. And so just to be clear, I think this is part of the session today. We're not going to go in depth in every solution. We're going to have some demos. That's why Zoe's here with me today. But it's really about understanding the value of the platform. And just to be clear, we have a number of solutions in that platform. We've got Power BI, which most of you probably already know, to get insights, do analysis on data. We've got Power Apps, which allows you to build applications. Whether you're in IT or whether you're a business user, it doesn't really matter. Everybody can build an application. We've got Power Automate, which is a tool, a set of tools to actually do any type of automations, whether it's on your desktop, whether it's on the server, whether it's in the cloud, any automation, we can help you there. Something new, Copilot Studio, which is our AI-infused chatbot, but it's actually built on that AI model that is used to build those images, that is used to build those videos. And then finally, Power Pages, which is that business-driven, data-centric websites that you can build without any knowledge of coding at all. And so these tools are what our business users are using today to build solutions, or what they're using today to actually optimize their processes by using them on a daily basis. And so that's the Power Platform. And there's a whole layer of data and security underneath. I will spare you in this call all of that. I think there's many more sessions that we can get you to. But I really want to inspire you on the value that you can bring to your organization by using the Power Platform. And so the way that we want to structure this and the way that we look at this is by something we call the patterns of value. And the patterns of value, like we've been in this business for 7 years plus, give or take. And so the patterns of value is kind of the summary of what we see at our customers, where they get their value through the Power Platform. And we actually have 6, but I really want to zoom in on 4 today, also through some customized examples. And so the first one is application modernization. And it kind of resonates when you think about that matrix printer. If that printer is an application or a solution, how modern is it? Is it really ready to support you in your business going forward? And so think of all the potential applications that you might have in the organization. Excel files, Access databases, old solutions built 30 years ago. I mean, there's hundreds of them in some companies, thousands of them. And we see that customers are using the Power Platform to actually modernize a lot of that application stack. Secondly, line of business extension. You know, most companies that are in this call, or people that are in this call, your companies will have a CRM system, an ERP system, a supply chain system. This is what we call a line of business system, something you use on a daily basis that really drives your business. A lot of these systems are quite complex and heavy, and you know, there's a lot of good data in there, but how do you get access? How does everybody get access to that data to then optimize the data, but also use that data to their benefit? How can I sell more? How can I market better? How can I have better stock inventory? How can I get more insights on costs? All of that is something that we see regularly happen through the Power Platform in combination with your SAP system, your Dynamics system, your Salesforce system, your ServiceNow system, whatever that is. It's really about connecting to the data to get the most out of it. Empowering departments, that's where most of the demos will will be going towards today. It's how do you give people who are non-IT people the power to change their own world? How do you give them the tools to build their own solutions? Because let's face it, IT sometimes is constrained with other tasks like networking and routers and laptops and security and teams. I mean, there's so many things that they are focused on that sometimes, business requirements are put to the end. And so how do you give power to those people to build their own solutions? And then finally, and for me, it's kind of the buzzword of the moment, it's hyperautomation. And hyperautomation it's all about how do I automate end to end. It's not about what we call bots or RPA. It's about how do I look at my process, whether I'm in HR, in sales, in marketing, in finance. How do I look at my process and optimize that? And I'll give an example, right? A lot of people say, oh, but we don't have any paper anymore. And that's true. A lot of companies have removed paper from the equation, but they've kind of changed it into emails. How digital automated are you? You just took the paper and now you put it into an inbox. So when you think about that, how do you take the data on that paper, get it into your core system, and then use that? That's what we kind of look at from a hyperautomation point of view. And so I think the message is you're not the first. You won't be the last. There's already a lot of organizations using the Power Platform today. I think the numbers on the slide is like, these are the S500s, which are the 500 biggest companies in the world. But we actually see this trend happen across any organization. Small, medium-sized, big, any organization is actually benefiting from these 4 patterns of value. Some more than others, but there is no organization where automation or application or modernization is not of the essence today. And so that was kind of the introduction, and it's good to kind of have that pattern as kind of the starting point. But let's now take a look at what that means with our customers. And so that's why I brought Zoe with me. And like I said in the beginning, Zoe's what we call a low-code specialist or a Power Platform specialist, and she meets a lot of customers. So Zoe, could you share a few examples of customers that have gone through this journey and the value that they've reached?
Yes, so one of the examples that I would like to share is an example of ExxonMobil. And ExxonMobil is actually one of those Fortune 500 companies that is really leveraging Power Platform in the organization. And they are mainly doing this also from a perspective of app modernization. So as a lot of other organizations, ExxonMobil actually had a lot of Excel files to actually help there with their core processes. And you can imagine that that's quite challenging because they use it for a lot of crucial processes where a lot of people were involved working in the same kind of Excel sheets. So let's look at this example. This is actually one of their processes that they have for annual maintenance planning. Yeah, you can imagine if you work with a lot of people on this Excel file and you have to put a lot of data from a lot of systems like an ERP system, like a CRM system, like a field maintenance system into this Excel sheet. Yeah, it's a lot of work, right? It's not really scalable. Also, of course, a lot of security risks involved, so they thought we should do something with this. And actually, what they did is they turned this Excel sheet into some Power Apps. So they actually used the data to develop a Power App out of it to make one scalable solution where everyone could work on, safe and secure. They thought it should take 9 months to develop this prototype for IT. But in the end, using Power Apps to create this, it only took actually 3 weeks to create a prototype for this solution. And within 4 months, it was up and running, live, and used in the organization. Yeah. And only already this example that they created, so this one application, saved $45 million. And that already within 5 months. And it's just one of the examples that they have. They have many more that they turned from, indeed, older systems, Excel sheets, into Power Apps.
Imagine how many Excel files there are.
A lot. It's insane.
Yeah, I agree. And so let me take you to another example, which is J&J Pepsi. And J&J Pepsi is not Pepsi. It's a bottling company in the US, which is a lot smaller than Pepsi. But of course, they work with Pepsi goods. So they were also looking at, okay, we're a kind of a medium to large size company. We're not an S500, but how can we optimize? And so like I said earlier, like one of the values was, how do I extend my core systems with a flexible solution? And so it's actually one of the coolest apps I've seen in my years in role and at our customers that I know of. And it's an app they call the Cold Space Allocator app. And the cool stuff about it is that this app is given to people in supermarkets who fill fridges. That's like they fill the rakes, they fill the fridges with drinks. But what they did, and this is the genius part, is that they took the data from within their core SAP system, history, pricing, product information, and they put that into the app as one data layer. The second layer was actually from their supply chain system, which is Dynamics 365 supply chain. And so they pull data on stocks, availability, delivery times, distributor information, discount information from the distributor, and they put that in there. And then they put a third layer on top, which is let's call it an early AI layer, which brings in demographics, like age, location, time of the year. And then they combine all of that, and they give a visual representation to somebody filling the fridge on like, what do you stock where? And just to give an example, when it's Thanksgiving, it's usually mom who buys the food because she's probably preparing dinner. When it's Christmas, people have different drinks because it's Christmas, and you've got Christmas beers or Christmas specialty drinks. When it's Easter, it's the kids who decide because they want to have a chocolate drink or a sweet drink. When it's Super Bowl, I mean, guess who would buy the drinks then? I'm guessing Dad, and I'm guessing there's more beer involved. But by combining all of that data, they modify how the fridges are filled, and they actually increase their sales with 10 to 15%. And this is a great example of giving the right data to the right people at the right place without them having to know what the hell is happening in the background. And I really love this example. So,
wow, great example.
I love it. Yeah. I wish I could build it.
Me too.
Yeah. So let's go. Maybe you have another customer you want to talk about.
For sure. I will take you quickly along to Shell. It's one of the customers that I worked closely with in the past years. They adopted also Power Platform within their entire organization, and I think it's one of the key examples of organizations adopting it to empower their departments. So Shell actually also generated or created together with Forrester a white paper around this, which is very interesting to read, so I would really recommend you to do this. But to give some details, what Shell actually did is they trained a lot of do-it-yourself developers. So that means people in the business really going to daily processes, build their own applications and solutions to optimize the processes. Which is amazing. And of course, they couldn't do it by themselves right from the beginning, but they had some coaches that had some experience to help them growing and learning. Within the first year, those people, so those 4,000 app developers, already created 75 applications that are actually in production, right? Cool. So not just small applications for personal productivity, so not something just for me, but actually something that has impact for the organization. One example of those applications is actually the application that they created for optimizing refinery furnace trimming, which is actually an application that they can use in the field to make sure they have the right settings set. Before they did this all just on feeling, some information in their mind, but now they actually have an application that helps them to find the best settings. And
I heard that it was actually built by an engineer, not by IT.
Exactly, one of those do-it-yourself developers.
Cool.
So it's really amazing. And actually only that application already saved $3 million. Only that application. Wow. Yeah.
Cool. But I can imagine that when a customer, or when we talk to customers and we say, hey, 4,000 people are going to build apps.
Yeah.
Some people might get scared.
Yes, for sure. Yeah.
So could you share how Shell kind of dealt with that?
Definitely. So Shell actually make use of a zoning model, a zoning governance model, where they define 3 different layers. The bottom layer, so the green zone as they call it, is mainly for citizen developers, so for the do-it-yourself developers, to create some solutions, personal productivity, all fine. If I leave the company, no one cares, right? I can take the solution with me, it's not a problem. Then they have the middle layer, which is the yellow or amber layer. And this is actually where a solution becomes a bit more important. So let's say my department is using it, right? So if I leave and I take the solution with me, could be a problem. So perhaps you want more owners. And then we have the red zone. That's the very critical layer. So the very critical applications, which should be IT owned. Okay. And of course it can grow, right? So you can imagine that solution maybe started from that engineer in the green zone, but actually is scaled up to the critical zone, the red zone. Yeah.
And I think that it actually resonates really well because it's exactly what IDC talked about, right? It's about IT still being in control, having full visibility, but actually leaving the creativity, the innovation up to the business users. And when they then combine those two efforts, I mean, you can get really cool solutions.
Yeah. You just saw it. It's amazing.
Yeah, cool. So let's take a final customer specifically on the hyperautomation piece, because the hyperautomation piece, it's a bit more complex, it's a bit bigger. Usually a lot of organizations already have an automation lead. And I think my challenge for you today is like, how do you think in a hyper-automated way? So another customer that I want to bring to the table specifically on that hyper-automation part is Coca-Cola. And it's actually the Coca-Cola bottling company, which is not Coca-Cola itself. But they have the same struggles like all of us. Like, how can I be more productive? How can I be more operational excellent? How can I save costs? How do I find the resources because I don't find the talent that I need to drive my business? And so they were looking at technology to help them in that. And so they have several processes, but one of their processes was actually mapping the order process and the invoice process and kind of matching that. So before they used this technology, they actually did this manually. Like somebody took the order list, then looked at the invoices that were paid, and then they mapped them manually. So now they're using the Power Platform to completely automate this from order to purchase, mapping that, putting all the invoices in a safe environment where everything is behind locked doors in a vault, to speak. But by optimizing this one process, not just on, hey, let's scan a document, but from the beginning, order entry, all the way to payment control, to putting the documents in a shared but safe environment, they save 10 FTE resources. And it's not about firing 10 FTE resources, it's about, hey, how can we then reuse those resources to create more value for the organization? And this is what they actually try to do with all of their processes. So they're using AI now to rethink, retool a lot of their processes to really find that optimization. Wow. And so we've talked actually about those customers, but we haven't really dug deep into AI, right? Because that's the big buzzword today. And so if I would be in the room with you and I would ask, hey, who has tried ChatGPT? Most people would probably say, hey, I've played with this. And my daughter, she loves it because now she can do tasks from school. She's allowed to, which is great, but we have to be a bit careful.
I wish I had that during my university time.
Well, let's say that it's changing. But what we want to do in the Power Platform is actually, we want to take it one step further, because it's not just about text. It's about how can I get AI into everything that I do. And so within the Power Platform, and within Microsoft, I hope you've heard about that. We're talking about copilots, right? This is your virtual AI-powered assistant that is there for you in every step of the way. And it's about generating content, but it's also about how can I use AI to be creative, to be more creative in what I'm trying to do? How can I use AI to automate those tasks intuitively without me being the one who is the blocker? And so we want to use AI in the Power Platform to make people go from working side by side as individuals to actually working side by side with your virtual assistant. And this is the cool part, because a lot of people in the organization today are already using technologies. Some of them are very basic, like Word. Some of them are very advanced. And so when you look at an organization, there's a lot of people who have a limited amount of tech skills, but that are already using a lot of, call them applications like Word or Excel or PowerPoint, even Access. And so what we want to do with the Power Platform, so before AI, we were already trying to help people be more creative, build their own solutions. But with AI, we're actually making it even easier for people without any skills. So, in the past, we've talked about low code. With AI, we're actually going to no code, where you can just use languages. And so we'll have some demos, I promise. And let's dive a little bit deeper into the solutions with that Copilot that we have today in Power Platform. And so I'm going to start with Power Apps, which is kind of our main product today, although that the rest is picking up quite fast. And as I said in the beginning, Power Apps is that application building tool that anybody can use to build applications. But now we've got a Copilot. And so it's really nice to put it on a slide, but I think it's better if we can show you. So I'm going to pass the word to Zoe, and she'll demo.
So thank you, Harold. So let's take a look at how we can build a Power App. So actually, I guess this screen is quite familiar for you, right? So it's your Microsoft 365 screen where you can find all your applications that you need during the day. Now, one of those applications that you can open from here is Power Apps. Now that I've opened Power Apps, you can immediately see that I have a text box where I can interact with Power Apps to generate an app for me. So let's say I would like to build an app for inspections of luxury cars. So I asked my Copilot to create an inspection app for luxury cars. And it's going to create the app for me. So normally, of course, I had to think about, okay, where do I start? And actually, by just chatting with Copilot, I can already make a data table that I can use to create my first application with. And of course, from there upon, I can connect it to other data sources and make sure that it's working within the organization. So as you can see, it created some columns. So it actually understood that I wanted to do an inspection for cars, and it gives me already some details about the cars and maybe some inspection details. But maybe this is not sufficient, right? Maybe you want to add more columns. You can even ask, what else can I add? So let's say you don't know what kind of data you need to collect. And it's giving me ideas such as add an inspection location. And I think actually that's a quite good idea, because you need to know, of course, where the inspection has taken place. You can now see that it even added the inspection location. So this is how easy it is. And on the top, you can even see that it automatically also sees that this is, for example, a date, and this is a text field. So it's really helping you creating a good data table that you can use for your application. So let's now create the app. So what is happening right now in the background is that Copilot and Power Apps is creating an application for you using that data table. It's using one of the out-of-the-box templates to make a first start of your app so that you can already use it in the organization if needed. Now you can see that the inspection app is actually finished. So as you can see, it created a first kind of template where I can work with. If I put it in play mode, you can already see that I can actually add new records. So I can add a new car model, inspection date. All the fields that we just created in that table are now editable in this application. And it's even responsive. So let's say you want to have it on an iPhone, also works. Or you want to have it on an iPad, also works. So it's one out-of-the-box template where you can easily start using a table created with natural language. But that's not it, right? So, of course, nice, you can create your first kind of page with your data. But from here upon, you want to make it bigger. You want to extend it, change things. But even therefore, we have the in-product Copilot. So within Power Apps, we have a Copilot where we can even say, add a new page, right? So I want to create a new page in this application. And Copilot is going to help me with that. So especially when I'm newer to Power Apps and I don't know all the functions, this is a very easy way to get along with it and get started. So as you can see, it added a new screen to my application. And of course, you can also still add components manually. So let's say you want to insert a Copilot. Surprise, another Copilot. You have a Copilot to create your app with natural language. You have a Copilot to extend your app or customize your app. But you even have a Copilot that you can connect to your data that is already connected to the app to ask questions, so for the end user. And in this case, you can even start connecting, chatting about, in this case, inspection data. And that's how easy it is to create your app.
So thank you, Zoe. And so let's go to the next one, right? Empower Automate is actually a lot of people are already using it, but are not always aware that they're using it. A lot of their tasks are already automated, but they might not know. So what we're trying to do now is like, how do you give that power to everybody to automate their tasks? And again, it's a really nice slide. It has nice, shiny, moving things. But let's show this, how this can help you. So I'm passing back to Zoe.
Yes, of course. Next to Power Apps, we also have Power Automate, one of our favorites. Now, as you can see, it looks quite similar, right? So within Power Apps, you had a kind of text box where you could add language and generate an app. Here we actually do the same, but then we generate a workflow. So let's have a look. So one of the things that you can, for example, create is a workflow that deletes the email of your manager. Maybe not the best example, but who knows, maybe you don't like your manager. Could be. So when I receive an email from my manager, delete it. Don't tell my manager I created this workflow, by the way. So actually what is happening now in the background is it is going to understand what I wrote. And it's giving me a suggestion of what kind of workflow I can create. So actually here we see that it starts with a trigger. And that trigger is when a new email arrives. If it's arrived, it will delete my email. That's maybe not completely the way you would like to see it. So I can also ask for a different suggestion. Now, actually what it is here is, I can already see, it's using Office 365 to get the information of my manager. And based upon that, it will choose to delete my manager's email or not. So if that's exactly what I like, I click on Next. I can set the connections, in this case, to my Outlook and to my Office account, and I create the flow. Now, as you can see, the flow is created for me, which is actually quite great. And from here on, I can start editing the flow. So here you see a bit of the same interface as you saw within Power Apps. This is the in-product Copilot. I can ask questions on this flow. I can add certain steps using this Copilot. One of the questions that I really like to ask, especially when someone else has built a workflow, is, what does this flow do? I'm just asking it what it does, and it gives me an insight into the actual steps that this flow is going through. So especially when it's very big, this really helps. Okay, so you see that's quite easy, same as with Power Apps. But maybe you do like your manager. I at least do, so I'm not going to put this one in production. But I'm to create another kind of workflow that is actually more useful in the organization. So let's go back and try it again with a bit more complex process. So in this case, I'm not only willing to use Teams or Outlook, I'm actually going to connect it to other kind of systems, like an ERP system or a CRM system. In this case, I'm using Salesforce. So I already typed it, as you can see. What I wrote down is, when an order arrives in Salesforce, request an approval via email from my manager and send me a notification in Teams. Actually, what it does right now is the exact same as with the other flow. It's understanding which kind of components I'm using in my sentence, what I'm trying to achieve, and based upon that, it's suggesting me a flow that I can use. You can now see that it's using the Salesforce connector, also out of the box, and I can start building my flow. Maybe again, you would like to have a different suggestion, also quite easy, where you can see a bit more details, maybe a bit more advanced. And from here upon, you have a great start building your workflow, and start building more and more of those automations in the organization to create value.
Thanks again, Zoe. And then finally, like we don't have the time today to go through every product, but I do want to kind of call out Microsoft Copilot Studio. Because Copilot Studio is kind of the new one. It's new and it isn't, but it's actually, how do we use that power of what everybody knows as GPT, but how do we use that within your business content where you can decide what data you're going to pick to actually chat against. And so, again, I think it's better to show you this really simple demo so that you can see the value of what you can do in just a few clicks. So Zoe, floor is yours again.
Yes, let's take a look. Next to Power Apps and Power Automate, we of course also have Copilot Studio. And maybe it looks a bit familiar to you, and that's because formerly it was known Power Virtual Agents, but we rebranded it and we also add a lot of generative AI functionality to it. So it's much more advanced. So let's take a look together. Together we create a new Copilot today. So first we start with a Copilot name. Let's call it EMEA Webinar. You can set the language of your Copilot. This is the standard language. Of course, in the end, you can still make it a multi-language bot. And we can start already creating it, or we can even add a website to it. And this is what we're going to do today. So I have a website open, which is the Microsoft Learn website for Power Platform. Hopefully familiar for all of you. Otherwise, I recommend you to take a look. Amazing content. So if we add this website to this Copilot, it will use the website to generate already information for us and using Azure OpenAI to generate answers based upon that context. So let's create the bot. As you can see, it now created the Copilot for me. And within this chat functionality on the screen, I can already start testing my Copilot. As you have seen, I have only connected it to the website of Learn with Power Platform information. So in this case, we can already check if it can answer certain questions regarding Power Platform. So let's ask, what is Power Apps? It will use the website content to generate an answer using Azure OpenAI, and it gives me information regarding Power Apps. Not only will it give me an answer, it will also provide me with a reference, because then I can always look at where the information is coming from to make sure it's valid. I can also ask questions like, can I connect Power Apps to SAP? And it will now do the exact same thing to generate an answer. And yes, of course I can connect to SAP. There's even a connector available, it says. So in this case, you can start chatting with your data. This can be any kind of website, which is publicly available, but there are also other options. So let's quickly explore. Within Copilot Studio, we have a setting which is called Generative AI. And within that setting, you can set all the settings related to, like it says, Generative AI. So in this case, I can add a public website. Now, as you can see, we just did that, right? But we can also add, for example, a SharePoint or OneDrive source. Of course, you then need to make sure you are authenticated, because you can only see the data that you're actually allowed to. You can also upload documents like PDF files and to use that to generate the answers for you, or you can connect it to Azure OpenAI. Now, this is actually very nice to create your chatbot very easily using content that you already have available. What you can do as well is you can make use of plugin actions. And I'm not going to all the details right now. Happy to tell more about it at a later time in a different webinar. But in this one, you can actually create a kind of connector, which means you're connecting to a certain system, like what is the status of my order? It will use SAP or Salesforce or Dynamics 365 to provide you with an answer to your question. And it's also using generative AI to find when to use that connection to answer your question and provide an answer back to the user. So this is a completely new way of generating chatbots, or copilots as we should call it, and it's definitely a game changer. So once your Copilot is finished and you would like to publish it and actually use it in production, you can start publishing it to the different sources. There are a lot of channels that you can configure and use your Copilot in. One is, of course, connecting it to Microsoft 365 Copilot. You can publish it in Teams, but you can also use it on your website or within a mobile app. You can use authentication if you need to reach certain sources, or you can just use it anonymously using public websites as a source, for example. So, as you have seen, it's quite easy to create your Copilot. You can start with it today, and within, 2 minutes, you already have a working Copilot. So go ahead.
So, You might have heard Microsoft come into the news with a lot of copilots. Copilots in M365, in your Office, in your PowerPoint, in your Outlook, in your everything. But we also have a copilot in Teams, like how do you optimize your calling, your team meetings. But you also have it in all of our business applications, like how do you optimize your sales? How do you optimize your service with Copilot for Sales or Copilot for Service? Even in our ERP system, we will have a Copilot to help you get into the core of what it is that you're trying to optimize every day. But within Power Platform, we even take it one step further because we can bring that power of not Copilot, but that OpenAI framework, that GPT power, we can bring that in your applications, in your automations, with something that we call AI Builder and the OpenAI framework. And so
connection lost.
Also here, I think it's best to demo this. And there's two demos that we're going to do. I'm even going to do a demo, which is surprising. But then Zoe will also do a demo. So first, I will do a demo on how you can just drag and drop an Excel file into your builder of Power Apps and how an Excel file becomes an app in just a few clicks. And then after that, Zoe will do a demo of what we call AI prompting, which she will explain a little bit later. So look, after the demos from Zoe, it's going to be hard to top that, but I'll give it a try anyway. When we started with the first customer story, we talked about the Excel file from ExxonMobil. And so one of the things that I want to show, which is not Copilot, but which is actually a feature within Power Apps today, is how can I use what we've already done in Excel files to actually build these applications faster. And it's going to be a very quick demo, but it shows the power of what we can do through that, that large language model. But I also want to call out that Excel is not a database, and neither is SharePoint. And so what I'm going to show you is actually Excel being moved into Dataverse, which is our core foundational layer on everything that we do within our BizApps suite, but also as kind of that foundational database we have on Power Apps. So I'm on the same page where we were before, where Zoe typed in, can I build a luxury car inspection app? But maybe you already have a file that you used in the past. So instead of building from scratch, I can also start to build with data. And you can start blank, that's simple. And then you really start from a blank canvas and you start from scratch. But you can also say, I'm already using an Excel file for the last couple of months and it's not perfect. And so if your Excel file has a table, you can actually take the Excel file, move it into Power Platform, in Power Apps in this case, and the large language model translates your Excel file into tables, columns within Dataverse. And this is where, you are, what Zoe showed earlier, right? She used that Copilot to build stuff. I used that Excel file as the starting point to build this application. And if you would then click Create App, it just uses that data as the starting point to build that application on top of that database. And the fun part is that as a business user, you don't have to think about it. If you have your data structured in a way, you put it in a table, you put it in Excel, you can actually start from there to build your application. So let's go to the next one. Thank you.
Thank you, Harold. Great demo. Let's now also take a look at how you can create your own AI prompts, right? So you can use Copilot. You can even import an Excel file and use generative AI to create a table for you and an app on top of that. But we can also use AI prompts, which are basically like you're used to with ChatGPT, but then actually within your safe own environment using Azure OpenAI within Power Platform to generate content for you. So if we look at the home page again, in this case, we are not making use of this chat box functionality, but we're actually going to AI Hub. Within AI Hub, you can find all your AI models. Maybe you already worked with that before, like document processing AI models or text classification, object recognition. But what is new is AI prompts. And with AI prompts, you can actually create the prompts that you're used to when chatting with, for example, ChatGPT, but again, within your safe own environment, where you can actually work with organizational information because it stays all within your tenant. So looking at the different kind of models, or models, actually prompts that are pre-created for you, you have respond to a complaint, classified text, but we also have, for example, summarized text. Of course, you can also create your own prompt and use that within a flow. But let's take a look at how you can use that. So let's say we want to summarize a text. You can imagine that you have a lot of text, which you often receive, maybe reports, and you only want to provide a summary to an executive sponsor or to your manager. This could be a very easy way to use an automation to use, for example, an email, to summarize that email and then send it forward to the one that should receive it to easily understand and see the highlights. So let's look at the text. So the pre-built prompt actually says to summarize the given text in a way that is easy to understand for a general audience. Now, it says something about including important information, including the main ideas, details, but still keeping the content order logical. Now, what we also can do is we can edit the prompt. So that actually means that we can add more things to it to take it into account. So let's add that we perhaps want to have 5 bullet points at the end. So provide the top 5 highlights in bullet points. Now, to test what this prompt actually does, we need a sample text. Of course, if you want and you save it, you can use it in a flow and trigger by an email and use the email body to do this. But let's take a look at how this works. So to give an example, we use the Forrester report that I mentioned before in this session regarding citizen development by Shell. I put it as test text and I'm going to test my prompt. So it are a lot of pages, right, going through to understand what Shell did. And of course, it's very interesting. But let's say I want to make someone enthusiastic to read this and only provide some highlights. Now, as you can see, this is the perfect prompt to generate the summary with the 5 bullet highlights to actually from thereupon share this with someone to make them enthusiastic. And of course, this is a funny example, but you can use it in a lot of different ways to create a lot of value for the organization.
So thanks, Zoe. And I want to finish with actually a final customer story, because you know, AI is a buzzword. Well, within Power Platform, we've had AI since 2 years, 3 years, maybe even longer.
Even longer,
right?
Yeah.
And so I want to finish with a customer, Equinor, and they're in the kind of transition of, like, you know, that traditional energy company into more sustainable energy. So they're rethinking a lot of what they're doing. And so they've got hundreds of apps and hundreds of people developing applications as well. And one of the apps that I really love is, I can't pronounce it because it's in Norwegian, but it's an application that allows them to count and invoice pipes. So before, you know, the pipes that you see on the image on the slide, before there was a person standing there counting the pipes manually, then going to the office, putting that into the system, sending an invoice to the customer who would receive the pipes. But the accuracy was actually 92, 93% on average.
I can imagine.
And so, but the customer received an invoice which was 100%. So every time there was a credit note, customer was unhappy because, like, you have to do payments and then ask for money back. So what they did is they created an application that actually counts the pipes. And the average accuracy is 98%. So by having the same person now use the app, first of all, the accuracy goes up. But second of all, the entire process is automated. So they use that data to then invoice the customer, which means they have a lot less credit notes. They even give the customer a small discount so that they almost never have a credit note, which means that the company saves money and the customer saves time and money, which is actually a really good thing.
Wow.
And so AI is not something that is just a buzzword. It's already happening today. It's already there. So I would say, use it. Yeah. And so that kind of leads to another IDC source, right? We love working with IDC because they've got great insights. And so AI is something that is here to stay, right? And so by 2026, 85% of people in organizations will be working with AI. It's not something that is there as a must because of the technology. It's there because of the must for the people to become more innovative, to become more agile in how they do their business. And so we've come to the end of our session, but I do have kind of a summary of, I think, the story that we try to bring together with IDC. And I think that, for me, it summarizes perfectly with these 4 bullet points. First of all, innovation is not about technology. Innovation is about a strategy as a company, but also as a culture. How is it that Shell has 4,000 people building? It's not because the technology is there. It's because the company chooses to have it, and they have a culture and a philosophy around it. And so, and it's not about, hey, applications is the role of business, or application is the role of IT. It's about how can we work together to do it faster and to do it more modern. And then I know some people are, I wouldn't call it afraid, but they're kind of like hesitant to AI and cloud, but it is what drives innovation today. Without the cloud, without data, it wouldn't exist. Like everything that runs on those AI and GPT, you need that power of the cloud to run it. And then finally, and I think this is my main message for everybody who is not a developer, Power Platform is the development platform for everyone. So even if you're not an IT person, you can develop an application, an automation, without the need for IT skills. And so with that, I thank you for joining this session. The call will remain open for a few minutes. So if you have further questions, feel free to post them in the chat. Thank you very much. Zoe, thank you very much.
Thank you for having me.
Anytime.
Yes. Thank you.
Thank you.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups, is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurize the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
You're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward.